years into the pandemic, a global recovery is underway. Global vaccination rates are improving, and the world is adjusting to a new normal. Yet, the markets remain volatile.
Beijing's crackdown continues. Chinese stocks listed in the U.S. suffering.
The global supply chain is in turmoil. The Fed is rolling out massive stimulus.
We will continue to provide the economy the support that it needs for as long as it takes.
Could soaring debt trigger the next financial crisis? How can investors navigate volatility and uncertainty? Amid the volatility, where is the opportunity? We put this question to the biggest names across finance and economics. This is Bloomberg Invest Global.
Hello, I'm Shonali Basak, Bloomberg's Wall Street correspondent. On behalf of Bloomberg, I'm so pleased you can join us on this first day of Bloomberg Invest Global. The economic effects of the pandemic have changed the financial landscape. Today, the markets remain volatile. There are fee pressures and low rates. But amid all of the uncertainty, there are opportunities. And over the next 3 days, our terrific lineup of guests will help you spot them. Before we get started, we have a few tips to help you get the most out of the event. If you have any issues with audio or video quality, try to refresh your browser or use the chat box in the bottom right corner of your screen for support. You will be able to submit questions during these interviews, and we hope you do. We want you to engage with us. So if you want to submit a question, please click the white tab on the right side of the video window. If you note your name and geographical location, we'll give you a shout out. While we may not get to all of you, we'll try our best. Social media. It's Bloomberg Invest, hashtag Bloomberg Invest. Please use that. And remember, you can connect and engage with other attendees in the event chat that's in the bottom right corner of your screen. I'd now like to take a moment to acknowledge our U.S. presenting sponsor, Invesco QQQ, our presenting sponsors, Abu Dhabi Investment Office, Angola's Investment and Export Promotion Agency, Grayscale Investments, Do Business Jamaica, LetterOne, and Qatar Financial Center. And finally, our supporting sponsor, CMC Markets Connect. All right, let's get things started. We kick things off with a focus on growth opportunities in Abu Dhabi and the wider GCC.
Hello, I'm Manus Granny, daybreak anchor for Bloomberg Television, based in Dubai, covering the Middle East. On behalf of Bloomberg, I'm so pleased that you could join us. It's day one of the Bloomberg Invest Global and our special briefing on the future of business. Spotlights on Abu Dhabi and the GCC. Well, the pandemic has inspired the need for governments and businesses to build back better and refocus their drive towards new innovations across a variety of sectors. In this briefing, well, we'll take a look at the role of innovation and how that's playing into the economic recovery here in the GCC. We hear from international business leaders and entrepreneurs from across a variety of sectors and assess why the Middle East is a focal point for new ideas and thinking that is helping to create positive economic and social impact around the world. Let's start the program. But before we get to our first session, here to kick it all off is His Excellency Mohammed Ali Al Shufra Al Hamadi, Chairman of Abu Dhabi Department of Economic Development. So over to you, Your Excellency.
Distinguished guests, ladies and gentlemen, welcome to Bloomberg Invest Global. Over the next 3 days, we will seek to uncover the most valuable investment opportunities from around the world. Therefore, it's apt that we are starting the conference here with a spotlight on Abu Dhabi and the Middle East. I say that because there has never been a more opportune time than now to invest in the Middle East. We are known for being a global leader in the oil sector, but beyond that, there is so much more opportunity to be discovered in the region. Diversification has been a priority for years now, led by the private sector development and educational reforms. Nowhere is this more important than the United Arab Emirates and its capital, Abu Dhabi. Some of you may know that just recently, Abu Dhabi opened its doors even wider to the world by allowing visitors and investors to easily receive visas and register their businesses. These moves aim to create the most competitive business environment in Abu Dhabi. For those of you that may not be as familiar with the UAE and Abu Dhabi, please allow me a few minutes for a quick introduction. This year, the UAE is celebrating our year of the 50th. From a desert just half a century ago, a technology powerhouse and a business hub has emerged. We owe this to our wise and visionary leadership, who long ago saw the potential of innovation in the pursuit of progress. The role of technology and innovation in driving progress is indisputable. Continuous innovation is a cornerstone of economic development. It is what drives a country forward and ensures it stays ahead of innovation by changing the lives for the better throughout history. Recognizing the importance of innovation, the Abu Dhabi government introduced many measures to encourage progress. Foremost in our efforts is the Thrive in Abu Dhabi program, which aims to drive the economy's diversification and support the Emirates' strategic growth sectors to develop critical areas including culture, healthcare, research and development, and real estate. Additionally, this program aims to encourage and sustain investment in Abu Dhabi. The UAE's economy is now among the top 30 globally, with Abu Dhabi contributing 60% to the national GDP. In a year when FDI saw a slowdown globally, the UAE bucked the trend. FDI inflow to the UAE grew 44% during 2020, demonstrating the abundant opportunities here. Distinguished guests, our government acknowledges the important role that ICT and innovation play in Abu Dhabi's socio-economic development. We have identified technologies as critical enablers and drivers of our economic blueprint, and therefore we have invested heavily in advancing cutting-edge innovation. The UAE ranked first regionally in the 2020 Global Innovation Index, leading the region for 5 years, while Abu Dhabi has named the smartest city in the MENA. As you can see, accelerating innovation and technology take top priority here. In Abu Dhabi, the government has built an innovation ecosystem comprising business enablers that offer comprehensive company support. A key business enabler is the Abu Dhabi Investment Office, or ADEO, which is the government hub responsible for attracting FDI. ADEO launched its innovation program in 2020 to provide financial and non-financial incentives to innovative companies across multiple sectors to help them expand in Abu Dhabi. Other key enablers are Global Tech Ecosystem Hub 71, which houses more than 100 startups from all sectors, as well as the Abu Dhabi Global Market, an international financial center and free zone that provides a supportive business environment. We also have a thriving capital market in the form of Abu Dhabi Securities Exchange, some of the region's leading banks, and 3 of the world's largest sovereign wealth funds in Abu Dhabi. Ladies and gentlemen, everything we have done has been planned and executed by the government to transform the Emirates economy. But to truly succeed, the public and private sector must work hand in hand to achieve this vision. This is where our partnership model with the private sector comes into play. The government has worked relentlessly to provide all the tools that businesses need to grow. It is now time for the private sector to take over the reins and seize the ample business opportunities. We are ready to welcome investors from all around the world. Our promise to you is that entrepreneurs and businesses of all sizes will have the support you need to develop impactful solutions here. Whether you're a major corporation or an SME or a startup, you will find a thriving business community in Abu Dhabi. To conclude, I want to leave you with this message. Abu Dhabi is ready to support your ambitions and help you achieve accelerated growth in the region. Thank you.
Okay, Your Excellency, great conversation, great context there, and setting us up for the very first session of the day. And it is my pleasure to welcome Walid Al-Mukarrab Al-Mahari, Deputy Group Chief Executive Officer at Mubadala Investment Company. They know a thing or two about risk, and they've got $1 or $2 to deploy. So let's get straight to it. Walid, thank you for joining me. We're in the final stretch of 2021. There's a wall of worry mounting as we're speaking to one another. Give me your perspective. You're in America at the moment. Are you still confident about growth, US growth, and global growth going into 2022?
So greetings from New York, and thanks for the question, Manus. It's great to see you. So from my perspective, here's how I would think about that. So right now, when you look at the underlying fundamentals in terms of what growth looks like worldwide, not just in the United States, but in all the major economies, obviously at different rates and at different trajectories, you see pretty strong fundamental tailwinds that point towards growth. And so we see that in almost every major market that we look at. And whether that's as a result of some of the fiscal policy stimulus that we see, the monetary policy, the underlying robust performance of some of the large businesses that we see, so far things seem okay. But like every major prediction, you have to qualify it a little bit, and you have to say that there's a but there, right? And since I can't read the future and my tea leaves are as good as yours, I would say, listen, there's stuff that people worry about. You worry about things like inflation. And you worry about how that's going to play out over the next, I would say, 6 to 12 months.
Do you think, look, the word stagflation is much used and has been over the past sort of 10, 15 days. Do you think we are going to see a stagflationary period?
So, man, I'm not an economist, but I can tell you what I see on the ground. So right now, especially when you come to the United States, you see a period where, on the one hand, you see a pretty tight labor market. So I just heard an interesting statistic. For the first time in a very long time, you are seeing that job openings, so people who want to hire, exceed people who are looking for work by something like 3 or 4 million jobs. And so that tells you that the labor market is still pretty hot. And by the way, that's across many, many different segments of the labor market. I'll give you some examples. So I was walking around New York, and restaurants are, they're full, there are lots of people there, but sometimes service is really slow, not just because they're packed, but because, there's fewer wait staff, there's fewer folks just in general in services. And so a lot of opportunity that needs to be matched with people who will, work and help fill that up. So I think there's a lot of runway before we start hitting things like stagflation.
Okay, so there's a little bit of runway there. You say, look, there's always a caveat, and the debate in Washington, a little bit further away from you there, is about fiscal stimulus. To what extent is your outlook built upon the view that you will get sizable fiscal stimulus in the U.S.?
So again, we can't predict exactly when that's going to end. But here's what we see. We all listen to the Fed, right? So we've all listened to the chairman of the Fed. And what it sounds like, without knowing the future, is that stimulus, soft monetary policy, right, is going to be here to stay. And it's going to be encouraging. So I think what that means is that for the time being, at least, I would say for the next couple of quarters, you're going to see pretty accommodative policy, whether it's fiscal or whether it's monetary. And so that's likely what's going to happen over the next, I would say, 6 months. Beyond that, I can't predict. So I don't know what's going to happen. Right now, you see a new word that has been introduced into the inflation vocabulary called transitory inflation. And so that's there. And what that means is some people think, again, economists who study this for years seem to think that even if inflation tends to rear its head, it's going to come back down again relatively quickly. And so I think what a lot of folks are saying is, well, if you believe that, then the investment climate, the investment environment is going to be pretty okay and pretty encouraging, I think, for the next 6 to 12 months. But again, Manus, you and I have done this for a long time, and we both know that there are a lot of curveballs that can come out of left field. And so we just don't know what's going to happen. So it's important to obviously keep deploying capital. We as investors are looking at that. But at the same time, we always think about what the rainy day looks like. And in this case, inflation is an important element of that rainy day.
Listen, you've given me a lot there. I'm surprised that your time horizon, Waleed, is only at 6 months to 12 out. That to me is very short. But can I ask you, does that monetary policy, fiscal policy combo that you've just laid out to me with the time horizon for risk, does it still make USA #1 destination for allocation of capital?
U.S. has been and continues to be a really important destination of our capital. And so, look, the way that we think about that. It's so obviously, the fiscal and monetary policy that we just talked about is important, but what is more important is risk reward. And that's the lens through which we look at how we deploy capital. And so when we do the risk reward calculation and think about, hey, listen, I want to deploy in this particular sector this amount of money over this horizon, we do it when that equation works out, right? And so when the return is commensurate with the risk that we are taking, obviously we will look favorably. And right now, we believe that the U.S. is that. So it is favorable. And again, we think the fundamentals are strong. Now making a statement like that doesn't mean that markets may not correct. I mean, let's look at today, for example. The market is red today, right? And you could see that even stocks like Facebook, which have been darlings for the last year and a half, are not doing so well because WhatsApp, Instagram, and their entire social media platform happens to be off the air. And so stuff will move up and down. Right. And so notwithstanding that, we still do think that there's a lot of tailwinds, at least for the foreseeable future. And risk reward seems to be OK. But you have to be careful, right? And you want to make sure you don't overpay for things. And so, again,
but let's just contextualize risk reward, Waleed, because from what you correct me if I'm wrong, from what you've just said, it might almost be a healthy thing if there was a little bit of air taken out of the tech tires, so to speak, in the U.S. I know you've got an IPO. We'll talk about that in a moment. Would you welcome a moderate drawdown in big tech? Do you think that would be healthy?
Yeah, it's not about welcoming. It's that I think it's a matter of time before it's going to happen. So corrections always happen. What I can't tell you is it going to be a 2% correction, a 5%, a 7%, whatever it's going to be. But these things, man, come in cycles, as you know, and so there will be a correction at some point. But I think the key again, when you put your investor cap on and you have the investor mindset, if you deploy capital in good companies that are leaders in their field, you're going to do fine as long as you don't overpay, right? And so that's the equation that we always have to be focused on.
Let's talk about one of those rewards that you're going to offer to a variety of potential shareholders, Global Foundries, the IPO. You pulled the trigger on that, as I understand. Can I ask you why now? This is a long time in the planning, but why now?
Manus, you can appreciate that there's not a lot I can say about the Global Foundries IPO because we are in a quiet period right now. Yeah. And so what I can say is that this is a core company to Mubadala. It's a company that's been a key holding for us for many years, and we are all hoping for the best. So we think that we are well positioned from a sectoral perspective, and that this company is a leader in its space. And unfortunately, that's really all I can say at this point.
Well, let me go at it from a slightly different point of view, because our global audience are going to want to try and understand valuation here. When I look at Global Foundries, it's a U.S. chip manufacturing business in a world which is becoming more polarized between the United States on one side and China on the other. His Excellency Gargash talked about the potential for a Cold War last night. So do you think from a valuation, a risk-reward point of view, to use your words, that in a more polarized world, a U.S. chip manufacturing business becomes more unique in value relative to other options for global investors?
So I can't address any points relating to valuation, Manus, but I think yes, think about that as a strategic rationale. It makes a lot of sense, doesn't it? And so it does resonate.
And in terms of the overall chip global shortage, this is a theme that we've explored many, many times here on Bloomberg. What can you tell me about that? What are people saying to you? What is the latest view that you have on this global phenomena?
So Mubadala has always been a firm that has believed in partnership. And so when you have stressed supply chains, when you have issues where folks need to come across the table, it's a lot easier when you have that kind of partner set mindset and point of view. And so I can't think of a time in the history of whether it's Global Foundries or frankly any other producing asset that we have where partners will come to the table, we'll have a discussion, and we'll figure out ways to meet their needs. That's what any first class, I think, client-oriented business would do.
Part of the reason why you've agreed to talk to me and you're part of this family discussion is about capital deployed here to the GCC, to Abu Dhabi. And what went through my mind, which was here is yet another piece in the depth and liquidity story for Abu Dhabi. Global foundries will, in my humble opinion, add to that depth and liquidity. Is that part of the bigger narrative, Waleed? Is this an important step in that IPO, that series of IPOs?
So if you think about the Abu Dhabi market and you think about some of the changes that are happening on the ground in the UAE, one of the things that I can tell you unequivocally, Manus, is that if you just look at some of the regulatory changes that have been put in place, I would say over the last 12 months, you'll see that the pace and depth of those that are geared towards opening up the economy, making us more competitive as a nation. I mean, I've never seen this pace of change before, right? And so when you look at that, combined with increased IPO activity, especially on the Abu Dhabi exchange, you're seeing just one company after the other that's coming to market. I mean, it creates a couple of different things. Number one, it allows for the privatization of assets, which I think is great. Number two, it helps create wealth. It helps create wealth for both UAE nationals and residents, and frankly, anybody who would like to come invest into our markets to participate in I think that prosperity. Number two, and then number three, you're seeing the ability for folks to move in to our country just because of our safety, our track record, and because of the way that we've handled COVID. In addition to the fact that folks can own their businesses and obviously list them and do what they need to do, it is a very investor-friendly destination, and I think in many ways is reaping the benefits of I think what we've seen during this COVID era. So I, for one, am incredibly excited for what the prospects for Abu Dhabi and the rest of the UAE look like, both from a competitive perspective and from a capital markets perspective, I would say over the next few years.
Well, certainly there's a raft of IPOs, and we've covered them. So we wish you well and every success with that. Time is always the thief in these conversations, and I have two big subjects that I want to try and just glean your opinion. Xi Jinping has shifted his policy to the common prosperity. And for weeks, nay months, we've debated about the investability of China. I mean, he's ripping up the rule book on schooling, housing, and tech. Broad topic, short question. Is China still structurally and fundamentally investable for you, in your opinion?
Short answer, yes. So absolutely, things are changing. There's no question about it. So we have an office in Beijing. We have folks that are on the ground trying to really understand what's happening. But again, this is the second largest economy in the world. It is still growing. So far, we have not encountered any resistance from an investor perspective. I think you need to be careful. I think you need to rethink a little bit what risk reward looks like. And because we don't have all the answers yet, and because I think that story is still TBD, if you will, it's still developing. We're still trying to figure out where it's going to land, but we are still investing. We are still deploying capital in China, and we think that in many sectors the fundamentals are still pretty strong.
What is the most appealing sector for Mubadala in China, given the volatility?
Well, I can tell you one right now. We're looking at a couple deals. So we are now making a little bit of a life sciences push into China, and it still looks very, very attractive to me. That's one example.
Okay, and that's the one of the big topics that I want to get an idea on. I'm also seeing, in my humble opinion, a pivot to Southeast Asia at a federal level from the UAE. I saw it with Minister Bintuk a couple of weeks ago, into South Korea, more into Africa. And I want to get a sense from Mubadala's capital deployment point of view, will you follow, as it were, Minister Bintuk in deploying more capital with more of a pivot to Southeast Asia, perhaps, than to developed markets? Is there a lean? Is there a shift?
Man, it's not a pivot. It's integrating into the centers of economic growth. So we are investors, so we follow growth. So obviously we're heavily invested in the United States, but you can't ignore the massive economies in Asia. You can't ignore growth hotspots around the world, whether it's China or India or other places. And so clearly our portfolio has to reflect that. Otherwise, we are literally missing out on opportunities. And so, it would not be correct to coordinate, to characterize it as a pivot. Rather, we're continuing to invest in the United States and deploy capital there, again, for the reasons that I mentioned earlier. But we are also investing in places like China and India because we see tremendous opportunity.
To close off, we started and you talked to me about risk and reward. Nobody has a crystal ball, but as you and I speak to one another tonight, oil's trading at a 7-year high, and I have many different opinions about a gas and oil crisis, which could be a crisis for the world. To close this conversation, Waleed, are we facing an energy crisis which can cause some kind of existential risk to the growth story?
So here's what I think we are facing. So first of all, it's in nobody's interest to have sustained prices that are very, very high. So everybody understands this, and we all know this. But think about what's been happening over the last couple of years. You have not seen a large amount of investment. Actually, it's been virtually zero in capacity expansions, either in oil or gas or in coal or other forms of hydrocarbons. And so when you see that and you see some tightness like you're seeing in the markets today, you will see price volatility. You'll see the big run-ups that you're seeing today. And so, do I think that this is going to be a crisis? Unclear. I don't have a crystal ball in front of me, but I do think that for the next little bit of time, because we have not seen the traditional investment in capacity increases and that we've always seen over the past 50 years, there's going to be an impact. Don't know for how long, don't know how high it's going to be, but we're starting to feel that impact.
Well, it was a great globetrot on many global issues. I wish you well in New York with the business there, and we will see you on your return to Abu Dhabi and to the Kingdom. I wish you well, sir. Your Excellency, Waleed Al-Makarab Al-Mahari. Good evening, good morning, good night.
Thanks.
So that was the conversation with Mubadala, where obviously the messages are very clear. It's all about the opportunities in China, and there's a long way to go to stagflation, which brings us very nicely to the opportunities on my next panel. So it's a cracking lineup. So let me introduce the panel. We're going to address the private sector resurgence and growth opportunities in 2021. Sounds very grandiose. It's the owner of capital, the user of capital, and somebody who does something that actually manufactures real value. My panel, it's Ismail Ali Abdullah. He is the CEO at Strata. We have Alyssa Farah Antonius, cluster head for MENA at Citi, and Sky Kurtz, co-founder and CEO at Pure Harvest Smart Forms. So all the audiences are here. The topic, it's good to have you with me, is about private sector resurgence and growth opportunities. Let's just think about who we're actually speaking to for a moment and pause for thought. We talk about growth. We're all trying to grapple with what post-pandemic world actually looks like and what will growth be. So let me bring that first of all to Alyssa. You are the holders of capital at Citi. What are the biggest trends that you are seeing coming out this end of 2021 as we go into 2022?
Thank you, Manus, and good day to everybody. Coming out of the pandemic, clearly there was a lot of reflections during the pandemic in terms of how businesses looked at their own operations, and also, I would say, how investors looked at opportunities. From our clients' perspective, what it actually meant is that they had the time to reflect in terms of their efficiency, opportunities that can present as well. And so we've seen a lot of activity specifically from the region in terms of, consolidation. We've seen a lot of monetization discussions as well, and reflection on how do we create further efficiencies. So that's, I would say, from our clients' perspective. But then you see the dynamics of the availability of liquidity and some of the measures that, let's say, governments did as well as central banks did as well. So today we find ourselves where there's a lot of liquidity in the markets, a lot of liquidity with banks, a lot of liquidity available chasing good opportunities. So we're talking from an investor perspective. So the liquidity is there. And the interesting thing actually that we've been seeing is how these opportunities are also being looked at coming into our region. So In the past, while we saw a lot of monetization, a lot of companies looking at doing dual listings, we see today a lot of those are looking to be listed only in our region, which actually brings a lot of interesting dynamics. And all of these offerings and opportunities that are coming to the markets, you see international investors' appetite is there. So a huge opportunities, I would say, for us in the region. In terms of sectors, clearly coming out of the pandemic, we see hospitality coming back, we see tourism coming back, and these are at the core of our region. And I'd say today with Dubai Expo, and I'm very happy to be affiliated for Citi to be affiliated also with Expo, is we see the phenomenal activity that is happening overall in our region.
And I can certainly attest to that. I've been to the Expo site, and it's pretty stupendous. You mentioned the flow of capital into the region, Ellis, and obviously over the past 24 hours, Global Foundries going for an IPO in the United States of America. Fertiglobe, we had the CEO this morning on my program. Gentlemen, let me bring it to you. I want to understand risk. Sky, let's go to you first of all. When we were chatting, you said, I'm a hippie capitalist, man. I've got 22 nations working in a phenomenal site here in the UAE, growing tomatoes, greens, in a really hostile environment. Our global audience need to understand the risk of setting up a business here in the UAE and the GCC. You talk about risk. Make it come alive for our global audience.
Well, so I'm, this, Madison, my background. I used to be from the United States market. I worked in technology, private equity investing, and with a global mandate, I invested in many markets, Latin America, some in Eastern Europe, et cetera. So when I came here, I'm familiar with the perspective of investors thinking about risk as they look at international markets, and particularly in the Middle East. I would say, and I shared this with you, that I think that there's a bit of a frustration or a handicap, if you will, for those companies with great and compelling business plans seeking capital in this region. And we experienced that early on in our company. And I would mention that it comes from a combination of misinformation and disinformation. On misinformation, I think that there's certain risks, like what happens when Afghanistan has a challenge and how does that affect the United Arab Emirates? And if you're an international investor from the United States or the United Kingdom or Japan, you might misprice and misestimate how much that actually impacts a business like us, which the answer for Pure Harvest Smart Farms is de minimis. I think it impacts a US company far more than it's impacted us. And yet I received that question from many investors, right? Another example would be there's a perception that governments can assume businesses, right? That there's some eminent domain power hiding in the background affecting companies. And yet, this is a very vibrant and open capital market, and this type of behavior doesn't exist. In fact, it would be antithetical to what the governments are trying to do to open the economy and lead to foreign direct investment, right? And then on the disinformation, I think that there's actually, and I'll pick on my American media counterparts. Often it sells newspapers, and it's exciting to talk about the challenges of things like terrorism and scary topics that are centered in some way in some Middle East narrative. Yet I live here, and during COVID, it could have been one of the safest places in the world. People point to failures like NMC or Abraj as if they are commonplace, yet they are the exception, not the rule. So I would say that, of course, there are risks to an emerging market, right? This is a highly fragmented market. There are many different governments. You have to work in international law, like British law, and you have to work in domestic Sharia law. And so there's complexity to that in an emerging market. And you have to be able to get over that complexity and price that into your capital asset pricing models. However, the opportunity is great. The population growth is strong. Demographic trends are great. The economies are quite open. And we at Pure Harvest Smart Farms, right, we saw an opportunity in food, in domesticating food production in a market that was heavily import dependent. That kind of a thesis is powerful around the world, but it's particularly compelling in a region like this with a fast growing population, with limited amounts of fresh water. And it's a very ESG-friendly investment theme. And this type of opportunity are the ones that I hope investors see, because there are great returns to be made and great companies to build.
Well, we'll return to that in a moment. I know that you're carbon negative, which is probably music to an investor's ears. Ismail, let me bring it across to you, because you are at the core of the investment landscape here with Mubadala over the past 10, 12 years. But you run a business, a global manufacturing business based here in the UAE, in the aerospace industry. When I looked at your profile and I looked at the company, I just thought, my gosh, the challenge for this man must be about building teams, retaining teams, and human capital. But for our global audience who may be thinking about redomiciling wealth and capital, maybe in the infrastructure and the manufacturing side of the world, bring alive some of the risks and the challenges that you faced and perhaps beaten here in Dubai.
Well, thank you very much for having me, and it's a pleasure to be on this panel. Let me share with you a couple of stories about Strata. So Strata is an aerostructure manufacturing company. We manufacture aircraft parts for the likes of Airbus and Boeing. And we are proud that today our business grew from 1 production line to 20 production lines. 8% of the worldwide body fleet of wide-body aircrafts, these are your 330s, 350s, Boeing 787 and 777, have parts made with pride here in the UAE. Back in 2010, when we started this business, a lot of people thought that this is a new vertical for the country. There is a lot of risk associated with deploying capital into this part of the world. There is a lot of risk on OEMs to relocating some of these parts to be manufactured here in the UAE. Nevertheless, we worked with them hand in hand in partnership to transfer that knowledge here to the UAE. Now, there were immense challenges. For example, we were looking for a sustainable pipeline of talent to support our growth. Hence, back in 2010, we've also teamed with international entities such as Airbus Business Academy, Lockheed Martin, and we started developing training programs to attract talent and onboard them. Today, our Emiratization rate, that's the rate of local Emiratis working in our force, stands at 64%. And when it comes to women empowerment, 9 out of 10 employees at Strata are female. We were able to build this because we had a clear vision, as well as we had the right infrastructure here within the UAE. During the pandemic, our resilience and the character of the company was tested. And this is the second story. We were working with Boeing to onboard the largest production line that we have. That's the full tail of the 787 aircraft. And we had 2 choices to make. Either we stop, we drop the ball, and no one would have blamed us because it was COVID, and you can blame COVID for everything. We made a strategic decision to move ahead, and we were able actually to deliver. From my perspective, the UAE is a very attractive place to set up businesses, to expand into new markets. Recently, for example, for manufacturers with Operation 300 billion, the Ministry of Industry and Advanced Technology announced Operation 300 billion, where they want to increase the contribution of manufacturing within the GDP of the UAE. Moreover, there are a number of bodies that has been created to attract investments and to attract companies to set up activities here in the UAE. For example, ADIO, Abu Dhabi Investment Council, where they provide a lot of support for entities, and they were able actually successfully to attract a number of recognized brands to set up activities within the boundaries of the UAE.
Just hold that thought, Ishmael, because what I want to get a sense from Elissa is, here's a conversation, Elissa. You deploy capital, raise capital, lend, and structure for businesses and family offices that want to deploy capital here to the region. Can you, or would you be so daring as to tell me sort of the top questions that those family offices and those DM market CEOs ask you, or that they're most worried about? And you go, no, do you know what, the IFC, we've got X kind of regulation based on the principles of the UK. It's a high bar of high regulation here, isn't it?
So a couple of things when investors look at coming into the region, Manus, and the first thing that when they say, okay, what is the opportunity? What are the things we need to look at? And I would say one of the things that they, for consideration and focus, is clearly the rule of law and the regulations. And we've seen actually a number of kind of deregulations taking place, a number of measures taken place, not only in the UAE, I would say also across the region, because when investors come into the region, it's to access, I would say, if they're coming to the UAE, what is available in the UAE and from the UAE. And when you come into the region, you cannot ignore also the markets, the other markets and opportunities within proximity of the UAE, be it, in my opinion, the MENA region, GCC, and wider East North Africa, but also proximity to reach Africa at large and Asia, etc. So I would say rule of law, the deregulations that are taking place are extremely important. 2, attraction of talent is also at the key of any decision making. And 3, the availability of capital, and how do you access that capital? As I said in the opening remarks, liquidity is available, and whether that form of liquidity comes from borrowing from a bank or even accessing capital markets. So it is available. The focus should be on if you are coming to borrow, what does your balance sheet look like? How are you what are the cash flows? What are you borrowing for? Does it fit what you're trying to achieve as a client? So it's number of lenses that we would look at to see how to advise a client on borrowing. But in short, opportunities are there, capital is available. And the focus for all the investors are rule of law, talent, proximity, and accessing capital.
I'll bring Sky in to do his next pitch. I'll just stand behind him, and you can stand in front of Ellis and go for a nice revolving credit line of up to 10 or 15 years for the growth plan. Sky, let's bring it to you. I mean, you're already munching your way through capital. I'm perhaps being a bit disingenuous. You've got Franklin Templeton. You've got a Kuwaiti sovereign wealth fund. You've got Abu Dhabi sovereign wealth fund on board. I mean, I might be bold and ask you how much capital you've raised. You might even answer me. But give our audience a sense of the scale of capital that you've raised and the kind of challenges that you had in getting sovereign wealth money into your business. So Sky, I think we've just 1 second, Sky. I think we've just got one of those.
Sorry, guys. I think somehow I was muted. Apologies. So
no problem at all. Did you catch the question?
I did. So let me reply. First of all, I wanted to build on what Ellis had said, which is there is capital available and businesses are banked. But I'll be honest, in contrast to markets I've worked in, like the United States, particularly for SMEs, for instance, that are a backbone of any economy and of this country and this region's economic diversification narrative, they are underbanked. And I actually think that lends to big opportunities for those who are willing to do the work and come into the market and invest in either equity or debt into companies. Now, we've been successful navigating that, but I'll admit early on it wasn't easy. It was much more challenging than building a comparable business in the United States to access that capital. Now, to date, we've raised in total commitments $216.4 million of capital. That includes a $100 million commitment from our sovereign wealth partner, Wafra International Investment Company in Kuwait. But also we have a number of equity investors, including the government of Abu Dhabi. We've also, as Ismail mentioned, we've received incentives from the Abu Dhabi Investment Office, supporting our research and development and the development of our capabilities as a national and regional champion in ag tech. But also Franklin Templeton investing in a Sukuk, a very innovative venture debt investment that we did with a number of other investors, including Chow and Sancta Capital. And then now we continue our kind of thirst for capital, because it is a capital intensive industry building this technology enabled food infrastructure, right? And what I would say though is that as we're gaining scale and traction, of course, it's becoming easier and easier, and we're receiving lots of interest from international investors. But today already in our cap table, we have investors from Hong Kong, Singapore, New Zealand, the United States, Europe, and of course around the region in the UAE, Saudi, and Kuwait. So it's really a diverse pool of capital, but I will say it takes a lot of work and of course to attract those investors. But the final thing I want to mention, Manis, is that What I think we did, and I would advise this to companies who have big ideas and ambitions for the region, is get in the market and build a proof of concept, build something that demonstrates you have product market fit. And once you've done that and demonstrated the economics are real and the potential is there, and you're able to point to the market and your product in the market with acceptance, you can overcome those hurdles and attract that capital. But I believe for international investors, it's very attractive, right? There's a lot of companies here that are very high quality that are not as picked over as they are in other markets, where, I mean, some of my colleagues from grad school who are building companies in America, run out for a capital raise, and in 3 weeks, they have 4 term sheets all competing at crazy terms. This is a market where that doesn't happen. So in a way, I invite you to come here and help these companies build, but also you will see, big returns opportunities for rewarding you for that effort.
Well, can I flip-flop this question very, very quickly, because I want to bring Ishmael back into it. Are you, without disclosing what you're paying over LIBOR or what Ellis is earning over LIBOR, are you paying penal levels to fund your business here and in Kuwait and in Saudi? Do you feel that you're paying penalty premium for geographic risk?
Absolutely. I would say very candidly, we have that discussion. There is a perceived, and then it becomes real because perception becomes reality, discount to businesses in the region that is disproportionate to the incremental risk. Now, that's good for investors, bad for companies, and that's changing as we have successes out of the region like Careem that was sold for over $3 billion to Uber, as companies like Strata gain scale and market credibility in international markets. But today, there is the Middle East is on sale from the perspective of an investor. And that's difficult for companies like ourselves. When I look at my contemporaries like AppHarvest and Bowery and Local Bounty, some of these companies that have de-SPAC'd, receive multi-billion valuations, and they're smaller and less progressed companies than we are. It is challenging. Now, of course, we are graduating into that club, but it's a harder fight here. And you really have to, I would say you have to demonstrate more and work harder. The level of diligence that's done on us, the number of third-party advisors, you would think we were running a multinational, $200 billion company. The number of times I've dealt with a big 4 firm doing quality of earnings and all these types of efforts.
Okay.
On the bright side, it raises our game.
Okay, so that's it. There is a geographic discount, and you probably have to prove yourself more. Elissa, are you more demanding of your clients when they come in front of you at Citi here? Do you think the international investor asks more questions? Very briefly before we bring Ishmael in, because Ishmael, I want to know what you need next before you IPO. Elissa.
So, I mean, I totally agree with what Sky said. I think there's more education that we need to do from the region for international investors as well. And I would say there are a number of measures that have been taken from, let's say, non-deal roadshows. Even on, I would say, today you were speaking to His Excellency Walid, who's in the US. All of these senior visits that happen where they are also talking to investors is extremely important. But for investors, I would say yes, opportunities are there in our region, in the Middle East and out of the UAE. But when they come in, they have to have the mentality of what are they also bringing added value into the region and into the market that they are coming to do business in. Because it's not only just, I would say, opportunistic, right? When investors come into the region to invest, they also need to put something at the table. Is it developing talent? Is it, bringing in new practices, et cetera, et cetera? So it's a partnership, right? But there is work to be done from our perspective in the region in educating the international investors in terms of what are those opportunities and, pricing that risk. So we're seen clearly as emerging markets. And so they price that risk, but with more successes like Careem, Sky mentioned, and others that start to come up, I think that gap will be reduced, Manus. But I would say the ecosystem that is being made available for investors is quite unique in our region.
Well, let's bring it back to Ishmael. A little bit tongue-in-cheek. I don't get the sense that you need capital because you've got the backer from of all backers, really. Am I right? You've got enough capital. So what do you need? Is it the partnerships, as the listener says? Is it the technical expertise and skill? What do you need to scale up, apart from back to flying as many planes and needing as many planes as we needed before 2019, sir? What do you need?
So I think, let me address your first point. Everyone needs capital. Yes, we do have Mubadala Investment Company as our shareholder, but in order to enhance returns, you always need to raise it. Having said that, I strongly believe that the future is bright for companies that would like to set up here in the UAE. Recently, we've been working on an advanced manufacturing strategy, a strategy that will see Strata introducing a number of new verticals to its business. Today, we have two verticals, one related to aerostructure, the manufacturing of aircraft parts. The second one is related to advanced material. And there are other verticals that we are looking to onboard. So what we are looking for are companies that are willing to relocate activities here, to expand to new markets, work with us, bring those technologies. And from my perspective, that's very important to have a partner that will walk the walk with you, that is willing to develop activities here in the UAE. And we do have actually a lineup of a number of entities that are willing to consider the UAE as a regional hub for some activities. And some of these companies are actually considering the UAE as an international hub for their activities.
Well, let's touch on the hub. I mean, as you said, that's one of the attractions. Alyssa, can I bring it back to you? Because I'm going to ask you the question anyway, which is there's this, around town, it's this competition between Saudi and the UAE, and we're going to see perhaps this a growing apart and competition. The hub model, Alyssa, should we look at both Dubai, Abu Dhabi, and Riyadh, and let's say Saudi Arabia, not as in splendid isolation, but as complementary? How do you look at that? Are we going to split in two, or do you think it's both? There's a symbiotic relationship. You're going to need both.
Well, to be honest, and we do business in 100 plus countries, and when we look at the regions in general and the countries we are in, we always look at what is the opportunity and what is it that we want to achieve, and where is the best place to do it. So, coming back to your question, to us, the way we're seeing it is complementary. So what you can do in Abu Dhabi, and we've set up, for example, in ADGM, we also are in the DIFC, and we are onshore, right? We are also in Saudi Arabia. In MENA, we are in 12 countries. Does it mean that one country is better than another, or one place of doing business is better? The answer is no. It's all about the opportunity and how you bring your service to clients and bring it all together. We have in excess of 500 global clients that bank with Citi. So they land into the country and they say, Citi is there, yes, okay, we go open our relationship with them, etc., etc. So these clients are present and doing business in the region. So, they too are looking at these opportunities with a similar lens. So I would say absolutely complementing of what can be achieved rather than the way you framed it earlier.
That's fair enough. That's the whole point. That's the whole point of these conversations is to get the inside track. Sky, can I take it back to you, because you have scaled up. I mean, in many ways, you built a model, raised the capital, and grew the product, so to speak, quite literally. Tomatoes in the desert. I'm being colloquial, but you have proved and you've worked on energy and you scaled up. Give the audience a sense of your scale up and then your ambition and why you see the UAE as the hub and spoke model for you.
Yeah, certainly. We started our business here with a specific reason. We saw that you could have comparative advantage in farming in one of the harshest environments in the world if you had technology that could control the climate and allow you to use all that sunlight and all the other factor endowments of producing here. Low cost and abundant labor, low taxes, which hasn't been mentioned and is very attractive in the entire region. Also, great rule of law, stable legal environments to access international capital, because capital is important to our business. So it was a wonderful place to build a company like this. And I think one of the great things about being in this region and in the United Arab Emirates is instead of feeling like you're fighting the government to get your business done, you feel like the government's fighting for you. The ministers are accessible and they want to engage in good policy making, et cetera. So we found this environment a great place to build this company, perfect our solution, and now we're bringing it first around the region And then around the world, we're headed to Southeast Asia, where they also have import dependence for food, and where we can localize food production with a solution that was built and perfected in one of the harshest environments in the world, the UAE's desert, subtropical, hot and humid climate. And now we can democratize access to that food production. And really, it was made possible by building that here, capitalizing on the abundance of sunlight here, and then leveraging this wonderful business environment to build a company and to scale it. So we consider ourselves what we hope to be the new chapter of business in this region, where homegrown solutions can find their footing, build companies, and then bring their solutions to the world, instead of copying and pasting businesses into the region, which was a bit of the first wave of venture capitalism here.
I'm going to leave the closing comment to Ismail, which is, when you talk to international partners, potential investors in your business, what do they ask you the most about? What are they most concerned about, sir?
I think, we don't only talk to them. We bring them here to Al Ain, to our facility, to see what we were able to deliver over the past 11 years. The parts that we manufacture are extremely complex. These goes into aircraft, and we tell them, when we say something, we mean business. And if we have a vision to enter into a new vertical or set up a business here, the whole ecosystem is behind that company to deliver. From their perspective, they always look for reliable partners if they want to come and set up activities here in the UAE. And from our perspective, we try, if the partner is not Strata, then we try to match them with any other entity within the United Arab Emirates that actually meets their requirement and can do the job with them.
Okay, well, Ismail, after Global Foundries and Fertiglobe, I expected when you're ready to hit the IPO trail, you give me a call. I know Ellis is standing by to raise the capital, and you never know, Sky might have a little bit of extra left in the tin to deploy to diversify the income stream. I thank all three of you for joining me. It's been a great conversation, and I think for our global audience, an insight into the holders of capital, the deployer of capital, and a producer and a real manufacturer of value. I thank you for joining me. It's been my pleasure to have you all with me, and I would encourage everybody to, if you want to stay with the stream, and all you have to do is remain to the main agenda to access the next session. And with that, I bid you adieu. Good afternoon, good morning, good evening, wherever you are globally.
years into the pandemic, a global recovery is underway. Global vaccination rates are improving, and the world is adjusting to a new normal. Yet, the markets remain volatile.
Beijing's crackdown continues Chinese stocks listed in the US suffering.
The global supply chain is in turmoil. The Fed is rolling out massive stimulus.
We will continue to provide the economy the support that it needs for as long as it takes.
Could soaring debt trigger the next financial crisis? How can investors navigate volatility and uncertainty? Amid the volatility, where is the opportunity? We put this question to the biggest names across finance and economics. This is Bloomberg Invest Global.
Hello, everyone. Welcome to Bloomberg Invest Global. I'm Carol Massar, host of Bloomberg Business Week television and radio. Now, if you're just joining us for today's program, welcome, everyone. If you were with us for the previous hour, we're really delighted to see you again and staying with us. We have an amazing lineup of speakers and conversations that are planned for today. We want you to be part of the conversation. So definitely engage with us via the event chat and, of course, on social media as well. Our hashtag is hashtag Bloomberg Invest. I do want to jump right into it because we've got a busy program and day ahead. Let's get started. I'm joined today right now by Michael Sonnenshein. He's CEO of Grayscale Investments, and Sebastian Bea. He's president of One River Digital at One River Asset Management. Grayscale Investments, by the way, is a sponsor of Bloomberg Invest. Gentlemen, so good to have you here. I feel like a lot of things are going on, and definitely when it comes to all things crypto, it's complicated, but it feels like it's a much more constructive criticism that we are having today than we have had in a long time. Let me just ask you, should crypto be in your institutional portfolio? Michael, kick it off for us. I'm assuming you're going to say yes, because I know you've already talked to Bloomberg about pensions and endowments getting involved, but give us your take here.
Well, great to be here. Very excited to kick off this conversation with you both. I would say that depending on the type of institution that you are, crypto most certainly can find a home within the portfolio. One of the amazing things about crypto, whether that's Bitcoin, Ethereum, or other digital assets, is that they don't squarely fit into the definition of currency or commodity. And what we've really seen at Grayscale is that investors of all different investment mandates, and no matter where they've historically felt comfortable investing, that they've found an analog into the crypto ecosystem. And so allocations have come from global macro funds, risk arb funds, momentum funds, deep value funds, and both in the US as well as abroad. And I think for many investors, as they're seeking out diversification, trying to build more resilient portfolios, they're having a difficult time accessing asset classes other than ones like crypto, where the risk-reward potential just far outweighs any of the other things that they may be able to look at. So for many institutions, certainly seeing a home for crypto in their portfolios.
There's institutional investors, there's the asset management side in a big way. What about things like, though, Michael, when it comes to endowments and pension funds? What are you seeing in terms of that area? Are we seeing or starting to see any kind of serious buy-in?
Well, it's been a really interesting evolution there. Many of the pensions, university endowments, corporate endowments, they've long actually had allocations to many venture capital funds. And as you know, many of the VCs have been on the crypto train for quite some time. And so while I'd say maybe 18, 24 months ago, you could query an endowment or a pension and ask them if they had crypto exposure, and they'd sometimes say that because of that VC investment, that underlying had made investments in digital currency businesses or into digital currency protocols directly, that they somehow had some exposure. Now, through our conversations at Grayscale with many of these folks, they've come to realize that that's probably not enough exposure for them. And so we have begun to see endowments, pensions move into crypto directly, so that they have now really an appreciation for not only making investments in crypto native businesses that are supporting the picks and shovels of this industry, but also recognizing that having exposure to tokens directly could be a very liquid way to gain exposure to this asset class.
Sebastian, come on in on the conversation. Should crypto be in an institutional portfolio?
Well, thanks again for having us. Really appreciate being part of this conversation and speaking with both of you. Should is always driven by a client's goals and considerations, right? Their constraints. And ultimately, the assets are interesting, but for big institutions, I think the question is, what outcomes do these assets bring, right? What opportunities do they offer? And for us, there's really 4 I's. It's potential to offer a new inflation hedge, an investment in innovation, as well as a source of income. And lastly, for some, a potential play on inefficiency. When pension funds and endowments are thinking about what role these assets are going to play, clearly growth has been a part of that in venture. But when they think more broadly, they have to think about what are the problems I have in my pension fund today? And why are these assets uniquely suited? Why is this digital ecosystem uniquely suited to be the next allocation, right? At a high level, what we don't see in the industry is large dedicated asset allocation schemes that are pointing directly to digital assets. And we don't see a number of actual dedicated digital asset management companies. There's just 2 on screen today, and there's not many others. And that tells you how early we are. We think that there are analogs with digital with other new assets that have come before. Think of risk parity, emerging markets, et cetera, where pension plans at first had no exposure. And eventually they recognized that these new assets solved problems. And so they made dedicated allocations within their plans, and then dedicated managers went and served those needs.
So help me out here, because and maybe this is too simplistic a way of looking at something like the cryptocurrency world, and specifically just look at Bitcoin. In April, it was above 63,000. Late May, it was down to around 33,000. July, it was below 30,000. A year ago, it was 10,000 and change. Today, it's back around 50,000 for the first time in a month. I mean, if we saw another asset class with this kind of volatility, we would say this is high risk. It's not for everyone. Isn't this too the case, Michael, when it comes to things like crypto?
It's certainly the case. It's not for everybody. The same way that every investment opportunity is not something that every investor ends up actioning for their portfolios. I think one of the important things that Sebastian brought up that really should be something that viewers and those listening in should take away from this conversation and throughout the entire Bloomberg Invest event is just how early it is. You are seeing tremendous coverage around cryptocurrency and popular financial media. You're seeing the on-ramps into the ecosystem continue to get developed, but it really is still early days. Bitcoin's only been around for the last 10 or 12 years. And so one of the important things to remember when we think about institutions is that there are still some legal and operational hiccups when it comes to whether or not they can allocate. Many of them don't have the legal or operational wherewithal to hold a bearer instrument like Bitcoin directly or like Ethereum directly. And so what we're starting to see is some of these institutions either leverage investment vehicles that can give them that type of exposure, whether that's through Grayscale or otherwise, or they're actually developing dedicated funds whose documentation and investment mandate actually does allow for that type of exposure. So while I would say that it's still early days, that is probably the most important takeaway for folks listening to this, that it's not somehow when you see price movements that suddenly the wave has been missed or somehow crypto has gotten away from them.
Well, and Sebastian, on our planning call, you talked about a colleague who said, man, we've seen cryptocurrencies or Bitcoin have, bubbles and bursts, 5-6 times already. So to that, that certainly speaks to the volatility, but does it also speak to the resiliency of the crypto area in terms of it continues to come back?
Absolutely. We think that this asset class is new and important, and it's much more than 1 or 2 assets, right? We think that the resiliency you've seen in the case of Bitcoin and with Ethereum relates ultimately to the powerful impact that these assets could have in changing the way that we move assets, right? So the web moves information. And you see people talk about Web 3.0. What are they talking about? What they're talking about here is that cryptocurrency will likely be the way that we move assets around the world. That's why institutions are paying more attention to these assets and these opportunities, and that's why they're not deterred by the high volatility and the uncertain nature of the assets and how they're held. That's why, candidly, we were brought into the space by one of our largest clients last year. When we entered the markets and we made the largest institutional allocation to Bitcoin and Ethereum when Bitcoin was at 15,000 and Ethereum was at 400. Our client and other clients are definitely concerned about the volatility and the way in which these assets trade, but they see the potential. And they need, as Michael said, there are hiccups with regards to legal and operational. There are clearly structural impediments at a high level you could summarize as partners and plumbing, right? This industry is growing its partners in plumbing to enable institutions to onboard. And they're coming because they see that this may well be the way by which assets move in the future, and it's much bigger than a couple assets that are a little bit volatile in your portfolio.
I want to get into the regulatory environment because that's certainly a big piece of this. Let me just ask you, because you talked about Bitcoin, you talked about Ethereum. Those are two that we talk about a lot here at Bloomberg. Is it going to be a smattering of different currencies that stay with us? I mean, we pull up our monitor and the list is rather long, and we know that there's a ton out there. Is it Bitcoin that continues to be the dominant cryptocurrency? Is it Ethereum? There were some stories that I was reading this morning that the flows are moving out of Bitcoin and into Ethereum. Michael, what do you think? Do we know at this point?
I don't think we know at this point. I think that the digital currency ecosystem is continuing to allow for new use cases and new protocols to come into the fold. We've recently looked very substantially at protocols that are part of the DeFi or decentralized finance ecosystem. We've started to see the confluence of digital assets in gaming, digital assets in privacy, digital assets in file storage, digital assets and video streaming, right? We're starting to moving into these new use cases that were not yet imagined when Bitcoin and Ethereum and other major protocols had been created and brought into the fold. Now, while that is certainly the case and the barrier to entry to launching new assets is relatively low, we would suspect that over time, the hundreds, if not thousands of digital currencies will ultimately get consolidated. We often think about, maybe analogizing digital assets to the precious metals family. And we look at things like gold, silver, platinum, palladium, et cetera, all being part of a singular family of precious stones or precious metals. However, each of them have an addressable market, an addressable use case, and a different price. And through that lens, you may find that there's a cohort of digital assets that grow and thrive and coexist, and each of them do, in fact, occupy their own addressable market, have their own use cases and their own prices. Whether or not that's Bitcoin, Ethereum, other assets, it's early days, so it's hard to say what that'll look like. But if there's any telling how this ecosystem evolves, certainly going to see the emergence of more protocols before we see consolidation.
Before I bring you back, Sebastian, Michael, do you have a price on Bitcoin, though, since that seems to be the dominant player, though, that we talk about?
I never give Bitcoin price predictions. I've been in this industry for 8 years, and what I can tell you is really just what investor behavior has been. As you said, the Bitcoin price has moved around quite a lot, even recently. And so when we see dips in prices, we often see that as an opportunity and investors moving in to buy those dips. If they fundamentally have not changed their perception or their conviction in an investment, but they can buy an asset 10, 15, sometimes 20% cheaper than they could a day, 2 days ago, well, that's a compelling opportunity, and investors tend to action those types of opportunities.
All right, does 50,000 though feel low or high?
You know what? I'm not going to comment on that, Carol, but what I will tell you is that if you had asked me 18 months ago if Fortune 500 companies would be holding Bitcoin on their balance sheet, I would have told you that it would be premature to think that that would be the case.
All right, Sebastian, what about your take on Bitcoin in terms of pricing? How do you think about, pricing when it comes to digital currencies?
Sure, and I'll also jump on a comment that Michael had mentioned around kind of analogizing or thinking about these assets in the context of other sectors that have come before. I think that's helpful to think about Bitcoin and Ethereum as mining assets. But I think what Michael said, and we agree with, is the crypto universe is actually potentially far larger of a sector, right? We're talking about the potential for cryptocurrency to remake finance, which is a very large portion of the S&P 500. We're talking about cryptocurrency remaking gaming, right? And media and art. We were talking earlier in our conversation about the brain drain that's now happening from traditional, investment categories into crypto. And what we see from an investment perspective is that cryptocurrencies become increasingly important because the innovation that's occurring in these assets. These new assets are bringing some of the brightest and most creative minds in our country to solve problems. And so from an investment perspective, it's really hard to think that this will continue to be a narrow asset class when we see the level and importance of talent and the creativity in terms of assets that's happening every day. We were talking earlier, it's hard to keep up with the news.
Yeah.
And why is there so much news? Because there's so much happening here, so much innovation.
So I'm 10 minutes in and I've got to get to the regulatory side. No, it's funny because I was thinking of the headlines this morning, Tinder rolling out a virtual currency, B of A adding crypto research to meet the growing institutional demand. And then you had JP Morgan CEO Jamie Dimon saying Bitcoin has no value and authorities will soon regulate the hell out of it. And then you also have the Fed maybe releasing its long-awaited paper on central bank digital currencies as early as next week. There is so much going on. Let's talk about the regulatory oversight. Legitimization, a key word when you talk about this space and institutions and ETFs. You had Jay Powell last week up on Capitol Hill saying he has no intention to ban cryptocurrencies. You had the Wall Street Journal reporting last week about the Biden administration considering ways to impose bank-like regulation on cryptocurrency companies that issue stablecoins, according to those in the know. Feels like, Michael, big steps forward in terms of that legitimization. How do you see it? What are your anticipation in terms of the regulatory oversight when we get it and what it means for this really industry and really true widespread institutional adoption of cryptocurrencies?
Well, I think if you rewind the clock maybe 2-3 years ago, investors would often cite regulatory uncertainty as perhaps one of the elements of thinking about digital currency exposure that might give them pause. Today, I don't think that that's the case at all, and certainly not what we're hearing from investors. It is a patchwork, though, when you zoom out, when you look at the U.S. versus other parts of the world. Certainly here in the U.S., you've seen guidance around digital assets like Bitcoin and Ethereum from the SEC, from the CFTC, from the IRS, from the Treasury, from the Fed, from the Office of the Controller of the Currency. And these are all meaningful steps forward that, from our view, really validate the asset class and investors' minds actually speak to the staying power of the asset class. I think even just a year, maybe 18 months ago, oftentimes, new legislation may pass across the House or a congressman or a senator's desk, and they might not want to look at that because there wasn't, in fact, a strong understanding of these protocols and the potential that they have to create jobs, to create tax revenue, to embrace innovation. Today, these are topics that are being discussed on the Senate floor. We just saw this when we had the infrastructure bill come through DC just a few weeks ago. And you have never seen an industry galvanize so quickly to educate policymakers and regulators about the merits of these technologies. And so I think you're only going to see further adoption and validation of crypto from policymakers and regulators. However, policymakers and regulators have a tough job. The crypto ecosystem has a lot of momentum. It moves very quickly. It evolves very quickly. And so as we continue to unlock new use cases, see new attributes become developed around digital assets, it'll be important that we continue to serve as an educational resource to those folks so that they do approach regulation in a fully informed way and not just regulate by enforcement, but actually create new regulatory frameworks for these assets themselves.
How much of the slowness in the pace is just that this is a whole new asset class, Sebastian, or how much is it the old establishment, old Wall Street? I mean, you worked at BlackRock for a long time. I mean, how much is it the establishment pushing back and maybe fearful of what they're going to lose potentially in the process?
Well, I think when it comes to these assets, Michael's absolutely right. We've seen a lot of regulatory progress, right? IRS, et cetera, over the last few years. But there's so much progress that's yet to occur. Just backing up, if global financial assets are approximately 220 trillion, right? Crypto is approximately 2 trillion. That's 1%, right? It is so small what crypto is today in the context of what it could become, right? That's part of the reason why when we set up One River Digital, we started an advisory council that was chaired by the former chair of the SEC, Jay Clayton. He's joined by Courtney Elwood, who was the former general counsel of the CIA, as well as Harold Ford Jr. We think that there is much more regulatory progress to come. There's much more education, to Michael's point, that we are doing as well. And there's much more engagement that needs to continue to happen. There are various projects that we're working on with various partners within the United States that we think could help to retain U.S.'s position of leadership in finance. And candidly, that's what's at risk, right? Cryptocurrency is a significant source of innovation, and it is pointed squarely at the financial services sector. And we view our role to be part of that engagement, to be part of that educational process, to ensure that the U.S. continues to be a leader in global finance.
Let's talk about timing. We did a poll. We asked, when will we see widespread institutional adoption of crypto? And maybe we can bring up the numbers for everybody who's watching right now. In terms of less than 5 years, people said about 50%. Less than 10 years was roughly about 23%. Never was roughly about 27%. Michael, do you have a time frame for when you think this will happen?
So I don't look at the institutionalization of this asset class as a function of time so much as I think about it as a function of infrastructure. When I look at the companies and businesses that are creating products and services around digital assets today, they are developing world-class solutions natively for crypto. So we're talking about the development of indices. We're talking about order management systems. We're talking about tax lot reporting. We're talking about APIs. These are all being built around digital assets today. However, that infrastructure is not connected to the legacy financial system, which is why investors see such an opportunity within digital assets themselves. Digital assets are still not being accessed the same way that institutions are accessing stocks, bonds, ETFs, any instrument for that matter. And when you see that connectivity come into play, you know, whether that takes 6 months, a year, 5 years, we'll see, you're going to, in fact, see a tremendous amount of capital that can flow into this ecosystem, not to mention a lot more involvement from many more parties, both in the US and abroad. And that we feel is honestly going to be one of the biggest catalysts for this asset class in the near term.
Michael, you've been pushing to convert Grayscale into an ETF. I mean, any thoughts on when you said that would be, you've told us before that would really change the conversation. Just quickly, any update when you think that can possibly happen for you?
Yeah, so our flagship fund, Grayscale Bitcoin Trust, is ticker GBTC. It's the world's largest Bitcoin fund, and we are 100% committed to seeing it convert to an ETF. We are encouraged by recent commentary from the SEC that suggests that perhaps their previous concerns with the underlying Bitcoin market have maybe in fact been resolved, in which case GBTC could convert to an ETF format. We do think that'll be a watershed moment, not just for GBTC holders, but crypto overall. There are a lot of investors who've obviously gotten involved in digital assets like Bitcoin today through GBTC and other means, but there are also a lot of investors waiting on the sideline, waiting for the familiarity and the protections that come with an ETF wrapper. So it's going to be an important moment when the SEC is ready to approve those kinds of products.
Is it a 2022 story?
We'll see. I mean, recent commentary, the SEC chair is speaking again today on this topic. So excited to see if there's further commentary coming out of the chairman's office or perhaps the SEC staff around their thinking as they look at these applications.
Sebastian, just got about a minute and a half left here. I want to wrap up with the two of you. What needs to be on our minds as we continue to have these conversations about the investment world over the next 3 days here at Bloomberg Invest Global? NFTs, tokens, digitization. I mean, what is it that we need to be thinking about and keeping really front and center?
So I think that the key thing, and when we speak to our institutional clients, these large pension funds, endowments, sovereign wealth funds, it is to abstract from just talking about two assets to talking about the transformative power of this technology. And people say that they believe in blockchain, but they really need to engage with how these assets could change how all of their assets are eventually traded. If you understand what an NFT is and buying a JPEG for a price and securely being able to transact that, right, and to be able to move it without constraint, that starts to inform how you might think about the rest of the assets in your plan. And it really is to understand how much change is coming to asset management and finance, and to not be focused on the volatility in the price of two assets, but to be focused on how assets may change, how they move around the world.
Michael, saved you 15 seconds. Your final thoughts.
I would just reiterate some of the things we've said today, Carol. It's early days and crypto is here to stay. It's not going to be appropriate for every investor, but it first starts with education. So if firms like ours and Sebastian's can be of help, we welcome the opportunity to engage.
All right, going to leave it there. Gentlemen, thank you so much. Sebastian, Michael, thank you. Really nice setup for the next few days here at Bloomberg Invest Global. Guys, thank you so much. Thanks, everybody, for watching.
Well, good morning, everyone. Always good to follow my partner in crime, Carol Massar, and always good to be with Bruce Flatt over at Brookfield. Bruce, really nice to see you. You've been traveling. I've been traveling. The world seems to be opening up. If I were to ask you to describe the state of the world right now, what would you say?
Look, the really good news is the health issues have or are abating everywhere, and the vaccinations are working amazingly, and the world's opening up. People are back to business. People are back doing meetings, and so we're in that late stage of this where people are already back in the office. They have a plan to be back in the office, or they're soon to be back in the office, and that's really good. And so I'd say business is getting back to normal.
And so take me inside the real estate part. We're going to sort of break down the Brookfield empire, as it were, and look across the entire $600 billion or so in assets. But I got to start with real estate. It's what you're best known for. You're a massive landlord in cities like New York and London. I know you travel to those places and many more. What's changed about big cities and what's changed in the world of real estate over the past 18, 24, 36 months? And where do we go from here?
You know, there's been a lot of confusion, and it was natural because things got shut down and you couldn't use an office, so confusion reigned. But like everything, things generally go back to normal. These urban cities are urban cities because they're urban cities, and people like to be in them. Creative jobs are in those cities. They like to be by each other. They like to go to restaurants near each other. They like to work beside their colleagues. And most employment in those office buildings, people get trained by being beside their colleagues. And so I think we're going back to somewhere near where we were before, with maybe a little more, as the world's changing, a little more online remoteness, and a few jobs continue to get outsourced to places like India or other places, and that'll just continue. And that has continued always. And the thing, Jason, I note for you is that in all these great cities, the creative jobs always change. And I'll just use New York as an example. You can look 100 years ago, what filled the city, and then 75 years ago, 50 years ago, 20 years ago, and today. And it always changes. But it's those creative uses and the people that are needed to drive them that want to be in the cities.
That's really interesting. And, you know, it's also interesting to look at the real estate market. And as you dig into the numbers, your numbers especially, it feels like there were a lot of trades going on earlier in the year, a lot of realizations, a lot of property changing hands. Tell me about that and what you saw from your perspective.
Look, there was 3 or 4 months of 2020 when the world essentially shut down. Central banks pumped a lot of money into the system, as is well known today. And what came out of that is that there are significant there is significant money out in the markets today, both in the debt markets, equity markets, and in funds to be put into assets. So it's been a very good time for realizations, both in infrastructure, renewables, private equity, real estate, and we've been realizing on a lot of assets. I think we sold $13 billion of assets in the first quarter, 10 in the second quarter, and we'll continue this year. So it's not like we think that's the only thing to be doing, because we're buying a lot of things too, but it's a very good time to be liquefying assets. And remember, everyone had a pipeline of 6 or 9 months when they didn't do any realizations. So it's just that it's the wedge is opening up and people have been realizing assets.
So let's talk about infrastructure if we can. It is obviously top of mind here in the United States as we look at what's going on in Washington. And, even setting the political piece aside, this is a business that you are literally and figuratively heavily invested in. You see a lot going on around the world. Help us understand what that looks like when the rubber meets the road. What sorts of deals, what's happening, and where are you actually deploying capital here?
Look, I'll just use a couple of examples. The telecom infrastructure to deploy 5G and to wire the world continues to exponentially increase. And with that, there's enormous capital investment. Telecom companies don't have enough capital, and therefore they're looking for capital partners to be able to deploy that. The data center business and the cloud are deploying enormous amounts of money. Fiber to the home is significant to rewire the backbone of what's going on with everyone sitting at their home and using more and more internet. And as a result of that, the deployment of capital is significant. The amount that's going to be required to transition from our fossil fuel economy to the clean energy economy is very dramatic. It's probably the largest amount of money that will ever get spent in infrastructure over a 25-year period that's been seen before. So there's a very significant amount of money deployed, and that just means for operators that have capital that can put this money to work, it's a very good time.
And I want to talk about the transition business in a minute, but just staying with infrastructure, I mean, as we look across even today's headlines, you guys are mentioned in some more traditional type of infrastructure deals potentially, and pipelines and whatnot. How do you balance the sort of telecom type, next gen infrastructure with sort of the older, as it were, more traditional heritage infrastructure, as it were? How do you look at those markets?
Yeah, so I would just say all of our businesses split in two. They split into value opportunities and growth, and 5G and data center infrastructure are being invested into by us on the basis that growth will come because of the internet and the growth that's coming in fiber. And as a result of that, I call those growth business. And then there are value opportunities. Pipelines, which may have a terminal value sometime, you need to earn a high cash return to be able, and you have to have a view that you're either going to transition them to the new economy or that you're going to shut them down, and that has to be taken into account in your underwriting. So we continue to participate in both. And remember, this transition is going to take many decades. So it's not like it's happening tomorrow morning. You just have to be knowledgeable and cognizant of what goes into all of those.
It's safe to say that you guys were early to the sort of broadly defined infrastructure game. You could, a few years ago, sort of count on one hand the number of players of scale there. That seems to have changed. There seems to be more competition. How does that alter, if it does, your strategy, or how does it change the landscape?
Look, we just given our heritage, we got lucky to be in the infrastructure business a long time ago when very few were doing it. That allows us to have an excellent track record to be able to do things off of, both for counterparties that we're investing with and for clients that we're sourcing money from. But look, I think there are opportunities for all in infrastructure, because the amount of capital that's required, both by governments because they need money to fund new infrastructure because they can't put more debt on their balance sheets anymore, or by just the sheer growth that's required in, as I mentioned, fiber data centers and all the other infrastructure that's required transition in the world. All of that capital is very significant. So I think there's lots of opportunities for many.
And how would you describe the appetite on the part of your customers, the sovereigns, the pensions, and whatnot, for infrastructure specifically?
So look, I'd say they 20 years ago they had 3% of their portfolio in alternatives. Almost none of it was in infrastructure. 10 years ago they had 15%. Today they're 30%. And infrastructure's increased as a percentage of that everywhere, and we're seeing dramatic movement of capital. And it really breaks into two buckets. The fixed income portfolios of pension plans, sovereign plans, institutional money, the fixed income portfolios are earning zero. Therefore, they need private credit or other alternatives which supplant formerly fixed income portions. And the equity portion, which is an alternative to the equity portfolio but has less volatility. And so we continue to see very significant interest in putting money into the infrastructure sector.
All right, so let's transition to transition then, because this has really blossomed into a massive part of your business. You brought on Mark Carney, obviously a very well-known name, both in the world of central banks, but also in the world of climate. You guys went out and started raising money very aggressively there. The money is certainly there to do it. Walk me through where we are at this point in the Brookfield transition strategy.
Look, we've always had a strong emphasis on making our companies the best they could be. And for a long time, that's meant that we should have strong ESG policies across the board. So all of our businesses are transitioning to net zero in the next number of years. And they will, and we will have plans for every business that we have to transition to net zero. On top of that, we decided that our renewables business and our operating skills to transition businesses could assist other corporations with transitioning their platforms, their businesses to net zero. And the first thing most companies recognize is that the easiest way to start is to do that with renewables, and it's a very quick way to. So we're signing up companies to long-term contracts, and we're building them new renewables to transition their energy, because a big portion of the energy stack is today needs to be transitioned to net zero, and the most leading companies in the world. I could name you would pick 10 of the most leading companies in the world, largest market caps, and they're all in the forefront of this transition. And we're helping many of them and hope to help all of them transition themselves to net zero. The second step is, once they understand renewables and they can transition their power stack, then what we hope to do is to provide them money in their industrial processes to do the same thing. So we think there's a multi-decade stage where we continue to provide money to companies, and Mark's been very influential with our thinking on this. I'd say when we started, we had an idea, and he's refined that over the years, and we've raised a fund around it, or are raising a fund around it, and I think the opportunities will be significant.
And so, as I look across the portfolio too, one of the things that is really interesting, and you mentioned this in passing, is the private credit piece. We're almost exactly 3 years into your acquisition of Oaktree, which is obviously a big name in the sort of private capital, private credit space. Help us understand how that has fit into the broader strategy and what you see in the world through the Oaktree lens.
Look, the Oaktree business, Howard Marks, Bruce Carson, all their partners have had an excellent track record over the past 25 years. And we had an opportunity to buy 62% of it and become their partner. As simple as that. They run it. They did an excellent job beforehand, and we felt they could do an excellent job after that. All we've helped them with is some of the things around where we could operate businesses in conjunction with each other, and sometimes on the fundraising side. But they make all their investments themselves. What's happened since then is that interest rates continue to go down, and private credit is increasingly becoming, as I mentioned earlier, supplanting fixed income in portfolios. So this business on the credit side, performing credit side specifically, is going to continue to increase over the next 5, 10, 15 years, and this will be a big portion of the business to grow.
You've also expanded fairly aggressively into the insurance and reinsurance business. Help me understand how that fits into the broader theme.
Well, I'm glad you asked it after the last question, because essentially what insurance is that you need to, one, to underwrite liabilities, and two, you need to invest money into assets which can out-earn the liabilities which you take on. Our view was that the insurance business was ideally suited to the skills we had in investing, except interest rates had the capacity to continue to go down for a number of years. In the last 18 months, our view changed, that interest rates can't go much lower, because we didn't believe that interest rates would be negative for any long duration, even if they went there. And at very low interest rates, the liability risk was gone. Therefore, as long as we could out-earn on the asset side, we had a chance to earn excess returns. And so we're providing capital through reinsurance and through insurance to the insurance market or to other insurers. And what we are doing is providing our credit products to that, and it fits into two categories. We generate the largest amount of infrastructure and real estate credit in the world out of our portfolios, and therefore we have a very large group of assets to pick from, which others just don't have access to. And secondly, the Oaktree franchise is going to be very helpful to deploy that capital and out-earn the returns that we need to. So we think it's an ideal time to have gotten into reinsurance. More importantly, we think it's going to be an excellent business for the next 5, 10 years.
So you think about real estate, private equity, infrastructure, transition, insurance, reinsurance, private credit. This doesn't sound very alternative at this point, Bruce. Like, is that sort of an outdated term for what you and your competitors like Blackstone and Apollo and others do?
Yeah, look, they were alternatives 20 years ago because fixed income and equities were 95% of most institutional portfolios. Today, they're 30%. We think they'll be 60% of many portfolios within 10 years. And therefore, you're right, Jason, we should probably change the name. I don't know, if you have a good name for us, we should change it, because this is not alternative to portfolios. It is going to be the majority of most institutional portfolios 10 years from today. And those that can out-earn outsized returns for clients are going to collect the capital.
All right, so just as we wrap up here, people are back to the office, you're expanding your business. I've known you for a long time. You are an optimistic guy, but what does worry you? Like, what worries you that could slow things down or potential bumps, even as we just think about the next, few months and into 2022?
Look, the good news is we're coming out of a very tough period of 18 months. And it wasn't a traditional recession because global central banks flooded the markets, and they did the right thing by doing that. But if they hadn't, we may have had a depression. But because of that, we're slowly come out of this, and it's not going to be perfect. Nobody should ever think, and I try to always remember every other period that was tough. And this one is no different than those, and probably even easier right now. But we're coming out of that, and so we should have pretty good times for a while. And yes, people are going to talk about inflation, and yes, people are going to talk about interest rates going up. But I think all of those things on balance, in particular for the business that we run, are small comparisons. So we should have a very good run for a number of years for alternative investment managers.
All right. On time and under budget. Bruce Flatt, really, really good to see you. I hope to see you in person before too long. That's Bruce Flatt over at Brookfield. Thank you so much.
Hi, I'm Scott DeVoe. I'm the deals reporter with Bloomberg. I specialize in shareholder activism. We have the privilege today to have Jonathan Pollock, co-CEO, co-chief investment officer for Elliott Investment Management, the $48 billion activist fund. I was about to say it's based in New York, but now during the pandemic, they moved their headquarters down to Florida. John, thanks for coming in today. It looks like you're in the office. Are you in the New York office, Florida office, or?
Yeah, Scott, thanks for having me. We're actually in the Greenwich office. This is our new office in Greenwich. But as you know, we did move to West Palm, but we still have a substantial presence here in the Northeast.
You were part of the exodus from Wall Street to Florida over the pandemic. There were a lot of hedge funds that moved down there. What do you think that means to the culture of Wall Street going forward?
You know, I don't really know much about the culture of Wall Street. We're kind of, in it, but not of it. Look, I think that technology today allows us to be connected in ways that we haven't been in the past. I don't think it's really central to be located in a specific place. And so, yeah, I don't think that it has any big impact.
Okay, so the last 2 years have been obviously, unprecedented. I'm just curious, Elliott has a platform in private equity, activism, credit platform in distressed, a real estate portfolio. You're pretty well across the entire market, and I'm just curious, what kind of challenges and opportunities did the pandemic create for Elliott?
Well, you're right. We're not just an activist fund. We're a multi-strategy fund engaged in a variety of things. Look, we were busy during the pandemic lows, as everybody was. Probably didn't put enough money to work at the lows, but fortunately, we do have all these businesses, and it's a relative value game for us. So in the activist space, we're both long and short, and we're still, even at these levels, which are up dramatically from the pandemic lows, we're finding things to do. We've also been lucky to put money to work in the private equity space. And we're looking for companies that have sustainable cash flows that we can own with confidence through the cycle. So that's been an area of deployment that's been fairly satisfying for us. But also, we're in the direct real estate space, and we have been active throughout Europe mostly, but we've done some things in the States as well. So we've been pretty busy.
It seems like you've taken a lot of active positions in Europe this year. Are you seeing some kind of opportunity in the European market? And more generally, I mean, how does Elliott determine what companies it's going to target in an activist situation?
We screen companies globally, and each situation is unique. So we've never put money to work based on a specific geographic theme. It just happened that in Europe, a few situations did line up. But lining up for us means a whole variety of different elements need to come together. And they happen to with these companies in Europe, but we've been active, in the US as well. So we managed to do a lot of work. Each situation is unique. You have to go through and take your time and really pick your spots, and that's what we try to do. And we try to populate the portfolio kind of situation by situation, brick by brick, and that's how we build it.
I'm curious, it looks like inflation and interest rates are likely to continue to rise. What do you think that means to the broader markets and for Elliott's business in particular?
Well, I think we've all enjoyed the benefits of low rates for a long time, and ultra accommodative monetary policy globally. Anybody that's managed to put risk on the page in the last 13 years, but more specifically in the last 18 months, has been well rewarded. I'm not sure it's all genius. I think those tailwinds have made us all look good. But now I think the cycle is evolving. And so what does that mean? You know, if you think about just taking a step back, I don't know if you've seen these numbers, household wealth has increased by about $5 trillion for the last 5 quarters, $5 trillion. So I think we're at all-time highs for household wealth to nominal GDP, which is like at 6.25 times. At the same time, you know, we have household wealth at like almost a 50% allocation to equities. So you start to think about, is there real sensitivity to rates? Is that wealth imperiled? You know, Bank of America recently did some work on the S&P and figuring out what the duration of the S&P was, and I think they came up with 35, 36 years, and composition makes a difference, a lot of high growth companies. But then Goldman did the same analysis for the Russell 1000 and came out with a 22 duration for equities. Well, if you start fooling around with the numbers, you know, 100 basis point move for a 22 duration zero coupon is a big move. You know, it's down, 20%. And I'm not saying that the market's going to go down 20% tomorrow, but I am saying that there is sensitivity. Where that attachment point is, it's a whole nother question.
Do you have any sense of, when that might occur, or, why the market's not reacting at this point?
Okay. I think it's really, really difficult to know. Right now, it feels like we're in this Goldilocks moment with the Delta variant behind us, people coming back to value, rates rising. I mean, just in August, rates were, the 10 years at 110, we're up 40 basis points or so. And you haven't seen any real move in equity. So it's really hard to know when that comes. But right now, with earnings growing, I think, and again, with the recent past that it only has paid you to buy the dips, I think that mentality is kind of still in full swing. Hard to call it top.
Okay. So over the last few years, there's been an evolution in the credit market. You're a big player in the credit market, in particular in distressed. There's been a movement by big private equity players and non-bank lenders to move into the space, Blackstone, Apollo, even yourself, and displacing traditional lenders. What do you think that will mean as the credit cycle evolves?
Well, times used to be that in the cycle, there would be plenty of opportunities in the credit space. And I still think there will be opportunities. But I think, as you point out, the composition of the players have changed to the point where they're better placed to own credits, distressed credits, stress credits, through the entire cycle. So if there's a process, these players, the Blackstones, the Ares, the Apollos, they're better placed to hold on to it. So I don't know exactly what that means for the next cycle, but it could mean that opportunities are less plentiful. It's important for us to think about how to configure ourselves to play. And so, we're busy thinking about what that means to us, just to ensure that, we'll be there for those opportunities that do arise.
What does that mean? I mean, how do you position yourself for that kind of cycle if people are holding the paper longer?
Well, look, as we saw in energy, and I think as you've written about, there have been opportunities in the energy space for alternative players like ourselves, and I think that kind of space, whole energy space is in transition. There will be opportunities. It's important to have the depth of industry coverage, but it's important also to have some platform companies of your own to originate your own volumes, so you'll be able to put money to work throughout the cycle.
There's been an interesting situation developing out of China with the Evergrande situation, and it kind of highlights the risk of investing in China. Elliott's been hesitant, I think, to some extent to dabble in the Chinese market. Why is that? And I mean, is there any opportunity for you there?
Well, look, China's been a difficult market. For us, we're deeply involved in every position that we run. And, it's often the case that, we need to lean against the rule of law that's consistently applied. And I think in China, it's been one of those places that have made that more difficult for us. So traditionally, we haven't been big players in China. I do think that there will be opportunities as this kind of policy generated slowdown occurs, but it's harder for us to think about big deployments in that geography.
So another area that you've been quite hesitant to get into is the cryptocurrency market. I think at one point, Paul Singer referred to as the biggest scam in history. I was wondering if Elliott's views on the crypto market had changed much, or do you still believe that there should be some hesitancy in terms of investing in it?
Look, Scott, we're naturally skeptical about everything. Crypto is, it's really, I think it's done a lot for the world. I think blockchain technology is going to be rolled out through a variety of industries, and it's a really, really important technology. Whether, Bitcoin and Ethereum, survive at the end of the day, I'm not sure. Look, we just saw China, ban the use of Bitcoin for transactions. And when you think about it, and the whole space kind of impinges on the domain that's traditionally been, that of the sovereign. And so when I think about the potential risks, I think about, well, what happens at the introduction of an electronic dollar? What does that do to the value of crypto? And I'm not sure that it's a positive. I do think that it's likely at some stage we can see an electronic dollar that's controlled by the Fed. I think that has various elements that will appeal to the policymakers. Whether that can coexist with Bitcoin and Ethereum is I don't know, but I don't think it's necessarily a positive for the value of Bitcoin and Ethereum when it does happen. But when it happens and at what level Bitcoin and Ethereum will be at it is hard to know.
Yeah, it seems that, if there was a federal alternative, it might lead to some kind of devaluing of the existing systems. Is that what you mean, or?
Yeah, look, I think the whole value of, Bitcoin, Ethereum would be challenged if that were to occur. I mean, it's hard for us to invest in something that could be, effectively regulated out of existence with the stroke of a pen.
Right. So Elliott earlier this year raised two special purpose acquisition companies. Since then, the SPAC market has started to hit some hiccups, I guess would be the generous way of saying it. I know you can't speak directly to what your SPACs are pursuing, but generally, how are you viewing the SPAC market these days and the opportunities that might be available?
Look, as you pointed out, we raised some money in a SPAC. Important. I can't talk too much about our specific situation, but I will say that the incentives that relate to the SPAC run directly to our investors, and I think that alignment is important. Look, we think that there's a lot of optionality in having this money and marrying that with a full Elliott platform to find interesting investments. Whether we'll be able to do that over the 2-year period is an open question, but we think that there will be things to look at, and hopefully the environment changes a bit to provide a little bit of dislocation to find things that are compelling.
Right. So I'm kind of curious how Elliott, the mechanisms of Elliott actually work. So you've been co-CEO since, I think, 2015. You work alongside Paul Singer. You keep a much lower profile than he does. And I'm just kind of curious, how does Elliott operate with two CEOs? Like, how do you make a decision on your investments or your strategies?
I think most people know that Paul's deeply involved in every aspect of the business. It's only been 6 years that I've been co-CEO, but we've kind of been together in some form for 32 years, a bit like a marriage. You can kind of complete other person's sentences, but at the same time, you're able to constructively disagree. And so, we view ourselves as the ultimate risk managers at the firm. So what we're trying to ensure is that the right kind of risk is onboarded at the firm, and that we're there at the moments that key decisions need to be made. And I think we've been effective in doing that. We're also lucky to have a deep team. We have 6 partners, and I have a number of employees that have been with us for 10 to 20 years. We've recently augmented the ranks. We hired Zion Shohead from Citi, who's our COO. Rich Zabel, who's now our chief legal officer, joined us about 5 years ago, and so we managed to deepen the team. So we're pretty fortunate to have that kind of experience to draw on in big size.
So who overrules who when you have a dispute?
Well, I think, we have this natural give and take. I think he knows when I feel strongly about something, and, he's able to run with my decision, and I'm the same way with him. In this kind of partnership, it's really, really important to, never say, I told you so. We're been doing this a long time, and we know that risks don't always turn out the way that we'd contemplated from the onset. And so it's just kind of a natural. I yield, he yields, but both of us are focused on getting to the right place, which is what we try to do in all instances.
So we mentioned at the outset that you're in the office today. How is Elliott looking at bringing people back? You were one of the most cautious people in the beginning. You moved remotely very quickly as the pandemic started. What are you thinking about now bringing people back, and when do you think they'll be back in the offices?
Yeah, Scott, we were very fortunate to have the infrastructure in place to almost seamlessly move to a remote setting, and it's worked actually better than I had anticipated. Having said that, it's been 2 years now, and I think that there's a desire for people to maintain flexibility. I think people enjoy the flexibility of remote work, but also to convene with regularity. So we're planning on going back to the office in January. I think, barring unforeseen circumstances, we'll stick with that. Look, I think the COVID in some form is going to be around for a long time, and we just got to work through it. But there are important reasons for us to get back, and we will be getting back.
Are you thinking about a hybrid model or a flex model, or do you want people back in the office on a full-time basis?
Yeah, it's a hybrid model. We'll be working 3 days a week from the office. I think people, as I said, enjoy that flexibility, but also miss, the back and forth of convening in person. And so, we're going to do a little bit of both. Look, these things are always hard to know how they're going to play out. So it's a giant experiment, and I'm sure things will go, not according to plan, and we'll have to alter it. But that's the way we're going to start, and we'll just get into it and see what works and what doesn't.
Plus, I guess you have now the added integration issue of having your new Florida offices too. Have you had an opportunity to see whether that dynamic's working yet, because you haven't been back in the office, or?
No, we're still remote, and so we haven't really tested the full hybrid model. I mean, it will be a test, and it will launch in January, and we'll see how it goes. I don't really anticipate that much in the way of problems. We've been connected remotely for so long that I don't think working in other locations is going to be problematic. Plus, we'll be convening regularly together, having more kind of on-sites with the teams, and so I think there'll be a combination of ways that we satisfy having working from disparate locations.
That's great. Thanks again for coming in today, John. We appreciate your insights on the markets and on how Elliott works. We look forward to talking to you in the future, and good luck with all your future endeavors.
Yeah, thanks, Scott. Thanks for having me.
CMC Markets Connect provides global market access. enabling institutions to enhance their revenue potential through multi-asset liquidity provision and award-winning trading technology. Our 30 years of experience in the financial markets allows us to utilize best practices which we have developed and optimized to meet the needs of your business model. Realize new potential with CMC Markets Connect. Visit cmcmarkets.com/connect to find out more.
Good morning here in New York City. I am Eric Schatzker, editor-at-large with Bloomberg Television, and delighted to present to you here at Bloomberg Invest Global, Dawn Fitzpatrick. She is the Chief Executive Officer and the Chief Investment Officer at Soros Fund Management, the first person to hold both of those titles at Soros. It's always great to have you here, Dawn. Good morning.
Good morning. Thanks for having me, Eric.
Dawn, I'd like to start our conversation by talking about inflation. Europe is having a proper energy crisis, and so is China. For those who haven't noticed, oil is at a 7-year high. US natural gas prices have more than doubled year to date. Industrial metals are ripping at the fastest rate in more than a decade. Is this really a transitory phenomenon?
So first of all, I think on the energy side, it's largely a political phenomenon. I think Russia had a vested interest in natural gas prices being high in the context of Nord Stream 2 approval. And in the context of China, I think their decision around Australian coal, which
is to say not to buy anymore?
Not to buy anymore, to put them in the penalty box. What they failed to realize there is even though the majority of their coal is domestically produced, things turn on the margin. So while both of those, I think, are geopolitical causes, I think the interesting thing is when you look forward, high energy prices or high fossil fuel prices is not necessarily a bug of ESG, but it's a function.
An accelerant?
And it's by design that you will promote transition to cleaner energy with higher fossil fuel prices. So while not the cause here, I think when we look forward, this is going to be the new norm where you see spike in energy prices. And it's something I think we have to get used to. To your question on inflation, I think we've all been surprised at kind of how long this feels like it's going to last now. And the other interesting thing is, a lot of this is supply side inflation. And it's not clear that monetary tools really deal well with supply side inflation. And I think the risks are that this can become self-reinforcing. And again, that's something that we're relatively focused on.
So to the degree that you try to predict in the positions that you take what the Fed is or isn't going to do, if we are talking about supply side inflation and monetary tools, as many central bankers, including most recently Andrew Bailey of the Bank of England, have explained, right, they're built for the demand side of the equation. What do you think the Fed will do?
So I think the Fed is lucky because the U.S. consumer is in a good place and employment feels like it's really heading in the right direction. So, I do think we'll get the tapering announcement at the next meeting. And I think what was interesting is the speed of tapering. Obviously, it caught the market a little bit by surprise in that they said they'd be done potentially with tapering in the first half of the year. So I think the market liked that the Fed is maybe going to be less far behind. But by the way, if you watched gold in September, it was down 5%. So I think the fear of the debasing of the U.S. dollar has receded to a degree. Also, by the way, the IMF just came out with kind of reserve currency balances, and the U.S. dollar has stopped losing ground.
Yet Bitcoin's at 50,000.
Yep, Bitcoin's at 50,000. So I think that's the really interesting thing, is that I'm not sure Bitcoin is only viewed as an inflation hedge here. I think it's It's crossed the chasm to mainstream. It's, cryptocurrencies now have a market cap of over $2 trillion. There's 200 million users around the world. So I think this has gone mainstream. From our perspective, again, more than we own some coins, but more than not a lot. And the coins themselves are less interesting than the use cases of DeFi and things like that.
Let's go back to inflation for a moment. To the degree that you think it's going to last longer than people initially expected, what sides of that trade are you playing? Are you playing sort of the classic, treasury side of the trade, commodities or commodity volatility, or stocks, that potentially face margin pressure?
So we've been long some commodities, and we are short government bonds, not just in the U.S. Again, real rates are really negative right here, and I think it's a reasonably safe bet that rates are going to go higher. I think the one counter to that, and something that's worth watching, and I think checked the rate move last time, is bank deposits keep going higher, and they're just at an enormous level. So the amount of bonds banks need to buy on the other side of those deposits is enormous, and that will a little bit counter check, any material move higher in rates, and it's something that's worth watching, and you might want to trade the ranges here.
What if we're heading into a stagflationary period? Right, it's a word that people in the market are using more and more and more, and not for me to say whether we are or whether we aren't, but is there a stagflationary trade?
Yeah. So again, I would hope that we're not heading into a stagflationary area
from a human interest standpoint.
But to your point, it's gone from like not being a word that's common in our industry to being front and center. I think the one counter to that, though, is coming into COVID. One of the things that we were really struggling with was productivity. And while right now you see kind of wage growth trend clearly kind of firmly in place, and I think wages are going to continue to have upward pressure, the offset to that is potentially productivity, where you're really starting to see some sustained gains. And I think that is ultimately going to be the counterbalance, and really, really important to avoid stagflation.
The other thing people keep talking about, in addition to inflation and stagflation, of course, is what on earth to do about China. There's been this dramatic shift in domestic policy and regulation, right, for the private sector, with seemingly huge implications for investors who have made so much money on the backs of billionaires like Jack Ma, for example. And then meantime, the United States is trying to squeeze, the Chinese by cutting off supplies of critical semiconductors in software. Is China a buy or a sell?
So China, by the way, China is incredibly interesting at this at this moment in time. So if you think about where they are, they had residential investment, depending on if you count just first order or first and second and third order, something around 10 to 29% of GDP. But they have a shrinking population. So that is definitively unsustainable growth. So if you think about what Xi is trying to do, he's trying to rebalance his economy. And by the way, in a way that I don't think you or I would argue is not smart, but the way he's going—
In fact, he's trying to do some of the same things that people here would like to do, but just find incredibly difficult because they're so, politically divisive.
By the way, 100%. I have no doubt that there's politicians around the world that are jealous about the degrees of freedom that Xi has. But I think that what's caught kind of Western investors by surprise is kind of the step function fashion he's doing it in, and the economic damage he's willing to tolerate to get from here to there. And, as an investor, I think one of the things is, based on what's happened the past couple of months, it's pretty clear, every Chinese company is viewed to be a state-owned enterprise to one degree or another. The other thing I think from an investment perspective that's really interesting and that's gotten a lot of attention from Chairman Gensler and others is the VIE or shell company structure of Chinese companies that are listed here. And, I think that those companies will largely have to delist. And by the way, for a lot of them, there's a mechanism for them to just port to Hong Kong. But, for 20 years, Chinese tech companies having Western capital and a Western vested interest in their success very much suited China's goals. They don't need that anymore. So they can take their $700 billion and take it back onshore into Hong Kong. And I think that's what they're going to do. So when it comes to the U.S. Chinese listings, if I were investors, I'd be really careful here.
What about earlier stage investments, Chinese venture capital, for example?
So again, I think it's going to be a while before those have an avenue to go public. There's some really big names that might go public near term in Hong Kong to make a point. But I think overall, that path from private to public in China is just going to take longer. And valuations, I think, are permanently at lower multiples because of effectively the state tax and state utility.
That sounds to me, Don, like potentially a big problem for firms like Sequoia, for example, or Tiger Global that have done so well investing in early stage Chinese enterprises and then, riding their evolution to the public markets.
So nobody's going to cry for Sequoia or Tiger Global, and I think they have plenty of dollars outside of China that are doing extraordinarily well right now. But my guess is there's a lot of debates going on in their boardrooms about how aggressively to invest going forward. The other thing I would say about the asset management industry overall is that they're a little bit economically compromised. China has invested a lot of money in Western asset managers, so it's hard for them to take too hard a stance when it comes to forward investments.
Are you allocating toward China or away from China?
I would say we are not putting money into China right now.
Now, I mentioned Sequoia and Tiger Global. Those firms are emblematic in a way of the shift of money that we've seen out of public markets and into private markets, from liquids into illiquids. Now, Soros Fund Management plays both sides of that equation. Given the extraordinary returns we've seen, endowments, right? Endowments are not known for producing 50, 60, and 70% annual returns. And yet that's what we've seen because of the allocation they have to some of these fast-growing private market investments. What are the implications of that?
So I think this is an incredible moment in time. To your point, 2013 there were 39 unicorns. Today we have 840 some odd unicorns. You've seen obviously companies stay private longer coming into this year, and then all of a sudden you had the Fed, go extraordinarily low with rates, and what happens then is effectively your high growth stocks, the discount rate is close to zero, valuations go through the roof. So you had this enormous pool of private companies that now have decided to come public at an opportune moment in time. And to your point, it's driven just these extraordinary returns, but it's also going to create an asset allocation problem to a degree for these big endowments. First of all, you saw kind of public market funds start to go into private markets, last couple of years. Now, all of a sudden, because of this IPO activity, private fund allocations have a large amount of capital that's effectively in public markets. And what happens then is they're going to crowd out. It's like squeezing a balloon. If the typical endowment, they say they're 60-40, but they're actually probably 75, 25 or something like that in reality. But now, given these markups, that has gone even further. So, call it 90-10, and maybe it's 90-30 because there's a degree of leverage in there. What's going to happen is they're going to have to redeem from their traditional public managers that have net exposure. So your long onlys and your hedge funds with 60/40s are going to be under pressure, because when those asset allocators sit around a table, the private equity guys, their returns look better both on an absolute and kind of value add perspective. And if you don't allocate to the next fund, you lose your spot in line, and everyone lives in fear of that right now, given the returns they produce. So I think there's going to be some really interesting conversations around those investment committee tables of those endowments. And net, I think active managers in public markets will get squeezed. The people who won't get squeezed are the big multi-strategies that run low nets. So I know you interviewed Ken Griffin yesterday. He'll do just fine. He actually might be a winner out of this.
What are you doing? Right, you have a choice to make. You unlike an endowment, don't feel the same kind of pressure to chase those beautiful historic returns. Right, you can be more dynamic in your allocations. Are you putting more money into private markets? Do you feel comfortable with your public market exposure? And what vehicles, do you prefer? Direct drive, hedge fund, private equity, venture capital? What appeals to you?
Yeah, so we've been running more and more money internally in public markets. We feel like there are some advantages we can play to. And when we look at private markets, one of the things we've been doing more and more is trying to have partnerships with those corporates where we can be solution across their capital stack. So we're not just providing equity. We might provide a warehouse. We might provide a line of credit or straight debt. And I think being able to provide kind of that spectrum of solutions in aggregate, you get better access and you become kind of a more valued partner.
Now, you're going to face a decision at some point in the not too distant future, because one of your probably best, I'd have to imagine, private investments is the stake that Soros Fund Management has in Rivian, right? The EV maker or EV pickup truck maker, or truck maker, let's say, backed by Amazon, also backed by you, that's going to go public, perhaps at a valuation of $80 billion. Are you a long-term holder, or are you going to crystallize some of those gains?
I think my compliance people might yell at me for talking about this, but we think that is a great company, and candidly, we hope they come public at a little bit cheaper than that, because we want there to be a long-term value play there.
You want other people to fall in love with Rivian.
Yeah.
And one thing I haven't asked, again, just emphasizing sort of the freedom and the dynamism that you can put to work at Soros, is whether the recent, we're approaching correction territory for U.S. stocks, whether that has, whether you felt inclined, looking at where valuations were, to dial up your cash allocation, or whether that's something that feels more appropriate now.
So we have been building back up our cash allocation. Last time you and I talked, we back in March of 2020, we quickly put about $5 billion to work, and over the past 18 months, we've been building back up that cash buffer. So where we sit today, if we had next crisis, we could put another $5 billion to work in pretty short order.
That's pretty large. That's close to 20%, right?
Yeah, we use leverage. So again, because we own a lot of the public securities directly, we have the ability to borrow against those securities. So we have degrees of freedom. I think the typical endowment and foundation doesn't have. And again, we try to use that to our advantage every chance we get. In terms of where we are in the cycle, we are definitively late cycle. But one of the best trades this year has been selling vol. And it's because there's not a lot of places to go in a regime like we're in now, where, as I mentioned, rates are very negative in real terms. Corporate spreads are really tight. So I think you still want to own equities. I think you can take a little profits off the table, and as I said, build up liquidity. So that if we do get a kind of a misstep, you have room to lean in. I also think it matters where you are. So if you look at the Hang Seng on the year, it's down, 13%, while the S&P is up 14%. So dispersion across countries and across sectors is enormous.
Don, we have about 30 seconds to go. I'll take this opportunity to ask you for one or two of your highest conviction bets.
So I think recovery stocks are still too cheap.
Really?
And they should be bought here.
Why? How's that possible? Given what we've seen transpire over the last 18 months.
So if you look, and this goes back in part to the productivity issue, these companies have learned to do things better. And I think when you look at the U.S. consumer, they are flush with cash and they want experience, not goods.
Don, it's always great to have you. Thank you so much for joining us here at Bloomberg Invest Global. I'm Eric Schatzker, and that is Don Fitzpatrick, the Chief Executive Officer and Chief Investment Officer at Soros Fund Management.
And just like that, a reversal in investor sentiment. The stock market had the worst quarter since March 2020, yields surging, risk rising from inflation to stagflation, supply chain disruptions, and China's clamped down, China's slowed down. Let's get insights. Kiat is CEO of GIC, Singapore's sovereign wealth fund, which manages an estimated more than $450 billion in assets. Chow, Kiat, interesting times. I mean, China, a good starting point, because in our earlier conversation, you said it remains a source of investment growth over the long term. And we've seen carnage. At one time, $500 billion wiped out in a week. I mean, so much volatility, so much uncertainty. Would you be buying into China in the next 3 months?
Well, great to be here, Haslinda. Indeed, there are many things happening in the markets. In a way, it is also just like another day, especially over the last couple of years. We have got many of these different cross currents. So investors indeed need to navigate, through this treacherous water. Sometimes it feels like, and China, indeed has been in the news for the last couple of months with a slew of policy actions. We have been, of course, looking very closely at it. Our view remains constructive. We looked at, the various policy actions closely and find that they are analyzable. In fact, quite a number of them, in a way, investors have had heads up, in terms of what was going to happen. And the big picture really also is that if you are to invest in China, even the last 10 years, you would have seen 3 to 4 bouts of very, very high volatility. Every 3-4 years, you got a sell off of 20, 30, 40%. But each time, things come down and it comes back. So I think you want to kind of take that perspective, right? That expect volatility, right? Especially a place like China or other sort of more developing markets. Right. Do a lot of bottom-up work. Of course, you have to try and be agile. But in the main, when you analyze these policy actions, we would say actually it makes the system more sustainable in the long term.
You talk about getting the heads up. Both GIC and Temasek have been hit big by the crackdown, especially on investments in edtech. I mean, does that mean you didn't anticipate the crackdown despite the heads up you're talking about?
Well, I mean, we cannot anticipate, every action, but I think the direction that China has been moving in terms of needing to regulate, right? Data, needing to regulate financial leverage. I think those things, I would say have not been big surprises. Investors do have to reposition. For example, I think there are certain sectors which are going to enjoy more policy tailwinds. I think investors do. Well, I guess what people talked about, the hard tech, right? Areas that China needs to make sure, right, it has the right expertise. I think investors would look at those more favorably, right? Simply because the policy tailwind will be behind. So just like other investors, GIC needs to reposition. And I would say perhaps, with this move more to so-called hard tech, our expectation of returns also need to be adjusted. I think in the consumer tech or consumer internet space, historically, we enjoyed a very, very sort of quick, big return in a short, compressed period of time. But I think in areas which are more hard tech, requiring a lot of R&D investment over a long period of time, we simply cannot, have that kind of expectation.
China valuations at 20-year lows, Chow Kiat, anything looking attractive if you look at a risk-reward perspective?
Yes, I mean, on the surface, right, indeed, the multiples are, much depressed, especially versus the developed countries. But I think it's hard to have a kind of a broad brush view on that. You really have to do the bottom-up work. And in view of all these policy actions and what we could try and understand, I think every of our portfolio manager and analysts need to do the work, right, of frankly, adjusting, for example, previous growth projections, right? Previously, one might expect this company to, maybe own up to, say, 70% of the market share. But with the antitrust effort, maybe we have to adjust that down to 25%, right? And that has big implication in terms of growth and hence, I guess, multiples and valuation. So every asset, I think all the investors have to actually, one by one, right, go through that calculation.
You have a background in fixed income, and Evergrande's debt crisis has been front and center. Do you see systemic risk?
We don't. I mean, we believe that actually the problem has been quite well flagged as well. You might recall, actually, for a number of years, China, right, talked about, the need to rein in financial excesses, financial leverage, right, on top of, eliminating poverty, on top of environmental pollution, right? These are the three sort of big evils, right, that they had to tackle. So this is, I guess, another case of that first big challenge that they're trying to wrestle. And if you look at the balance sheet that the central government has and the regulatory power, we think they have significant, control, right, over the situation. So we don't expect that to be systemic. There will be some pain, inflicted on certain segment of that value chain, but we don't expect it to, come out to be a big systemic problem.
Would you buy Chinese bonds right now? Would you buy Evergrande bonds right now?
Right. Well, do the homework, right?
Is that a yes or a no, Chow Kiat?
Selectively, yes. Right? It cannot be a broad brush thing. Actually, any market, especially these days, you cannot kind of approach it on a top-down broad basis. You have to deploy your teams on the ground to do so.
How are you looking at your portfolio? Asia ex-Japan accounts for a quarter of your portfolio. China, the bulk of it. Are you maintaining that over the next year, given the state of China right now?
Yeah, well, I just said, the top down, we have to be careful. But still, I think venturing a view, given the valuations and our constructive view on the longer term development, we would continue to be active. But as I said earlier, I think the result could be some changes to the composition of our exposure, right? Favoring those sectors which we think will enjoy the tailwind, and then limiting, right, those which, maybe no longer are in line with the government policies.
As a rule, GIC invests outside Singapore. Do you think this has been positive or negative for your AUM?
Well, that's our mandate, which is to really, deploy foreign reserves in global markets. I guess over now 40 years, right? We are celebrating our 40th anniversary this year. The result has been quite productive. So I think we don't really, sort of look at the alternative of investing in Singapore, because that's just not what the mandate is.
As you said, you turned 40 this year. What do you think will be the biggest difference between the GIC of today and the GIC of 2031 from a portfolio perspective?
2031, wow, that's 10 years out. I wish we can be as successful or even more successful. Really, looking at, of course, keeping the same mission, right? I mean, often in chats like this, we talked about change, right? What are going to change? But actually in the GIC, we put equal emphasis on what shouldn't change, right? So there are certain things that we wouldn't change, keeping our long-term perspective, invest sort of with a fundamental mindset, and of course, all the values that we have got. But certainly the world probably will look quite a bit different 10 years out. So hopefully GIC is also, in my old boss's words, in time for the future, right? That even the capabilities we built today, and I guess going forward, put us in good shape, right? Because there are a couple of big changes which probably won't go away for a long time. I think tech, we talked about that before, right? It's just continuing. All this disruption is what we expect. Sustainability, another very big theme, now getting very, very big momentum. And maybe that last bit of geopolitics, right? Also not going away. In 2021, I guess if we were to have another conversation, we probably will still be talking about, aspects of these three themes.
Well, let's pick up on sustainability. GIC has been talking more and more about sustainability, but it also continues to invest in things like gas pipelines, companies that provide services to shale drillers. I know that you're going to say you're advising these companies to become greener, but wouldn't institutional investors have more of an impact if they stopped funding fossil fuels?
Right. So this is a difficult question in the sense that if we were to look at our own sort of portfolio carbon intensity, a quick way, right? A quick way to reduce that is simply do what you sort of suggested, right? Just sell them, right? And then we can be happier with the number. But as many people have pointed out, that's also not the best way to help this important cause of climate change. So indeed, we work harder on transition engagement, be sort of more methodical about it, deploying sort of resources to try and help companies. You might have seen, some months back, at the end of last year, we did that big investment in Duke Energy, Indiana, right? I think that's probably a good example of how you can actually deploy capital to help, in this case, a utility to change from sort of coal energy to renewable energy. Otherwise, if investors just stay away from that, actually, the company will find it harder, right, to make that transition. So we hope to be able to find actually more and more of these kind of, opportunities. In fact, even better, we will engage with regulators, right? Because in that particular case, it turned out that the regulators have a regime that allows or that encourages that kind of investing action to help the transition. So if we can actually sort of share that regulatory regime with more regulators, actually I think the impact will be even greater, right, than just depending on people's buying and selling.
What would you like to see from the regulators, from governments?
Right. So, as I cited that example, be very, very thoughtful, right, about what the companies need and the trade-off, and put in place the right incentive, I guess the disincentive as well, to move along that journey, right? Maybe quicken the pace. So GIC actually a couple of months ago also joined a bunch of other institutional investors to engage with the energy companies in Asia, right? So in that process, we want to be able, right, to share these kind of ideas with the companies. But if we get the chance to meet the regulators, we would also explore with them. Maybe there are these regimes around the world which may or may not be suitable, but at least I think they should get to hear about them.
GIC takes a long-term perspective in its investments. When you take a longer-term view, what are the most exciting opportunities in the sustainability space? What trends do you think are most attractive?
Yeah, it's actually really interesting. I think now we are in this period, I would say, of great momentum, right? Meaning doing good and doing well can coexist now, right? Before that, there was a period where there was great trade-off, right, between return and sustainability. Not in the last maybe 2 years. And I hope going forward, right, more and more of that momentum of, that if you invest, in fact, in sustainable technology, for example, you actually get good return. And we are seeing, in fact, more of that happening, especially, I would say, coming out of the tech space. We are now seeing serious efforts on hydrogen, serious effort in decarbonization. In fact, GIC has invested in a number of these, sometimes startups, to try and deal sort of head on, right, with this carbon emission challenge. So I would say, from sort of defense, we are moving more into offense, right? Defense, of course, would just mean how do you protect, your portfolio value, right? Because some of these, say emitters, is going to destroy value. But instead, we have to continue to do that. But in addition, we have to do more offense. So we reported, for example, in our annual report 2-3 months ago that we set up an internal sustainability investment fund. That is a vehicle, right, for us to go on the offensive, to find these, startups or, I guess, electric vehicle companies and things like that, to actually not only kind of protect, but generate sometime, hopefully, outsized returns from these activities.
Kiat, any plans to make your portfolio net zero by 2050?
Well, I guess we always want to keep moving in that direction. There are actually a lot of internal efforts, right, from the earlier kind of measurement effort to now, a lot of engagement to try and look at sector by sector, how are we able to reduce the carbon intensity. But we are not, I would say, very keen to just kind of make a pledge and then, for example, end up, selling the emitters and not really helping the cause. Rather, we would like to work with, I guess, as many people to try and find, sort of concrete ways of reducing intensity over time. But we have a whole lot to learn, seriously, right? That this is an area that is important and rapidly changing, but certainly measurement is part of it.
In wrapping up the conversation, Chow Kiat, what do you deem as some of the biggest risks for investors today?
Wow. Today, as we started this conversation, right, with the idea of cross currents, sometimes you feel like, there are a few things that you can get ambushed. I would say in the main, the rather high valuation, right, propped up, at least in part by strong liquidity policy, remains a challenge. Of course, the central banks have been talking about tapering. They're very careful, right? Rightly so. But that, in particular, if we actually encounter inflation pressure, might be a big challenge to deal with, right? So that's one. The next, I would say, is all this kind of geopolitical developments, because the nature, right? The nature of these is one of like an event risk, right? It's very digital, that you can get permanent impairment quickly. So that's pretty challenging to deal with as well. I mean, we try to, of course, run a diversified portfolio, take a long-term approach, but from time to time, you get, these kind of events. And then finally, always at the back of our mind would be something like a cyber attack, right? We have seen examples already in recent times, right? Attacking, electricity grid and stuff like that. So you do worry a bit whether if there is an even larger scale attack, what's going to happen to financial market and what's going to happen to some of our holdings. And that's a really difficult one to prevent or to manage.
Lim Chow Kiat, CEO of GIC, we thank you for your time today. Thank you for your insights.
Thank you. Nice talking to you.
And you, Chow Kiat. Take care.
Well, hi, everyone. Jason Kelly here with you again. Delighted to be back and delighted to spend some time with Don Cornwell over at PJT. And Don, really nice to see you. We're going to talk a lot about sports. And what I find so fascinating about this, as I was thinking about it, and you and I were talking a little bit, is investing in sports 5, 10 years ago, maybe even 2 or 3 years ago, would have been a relatively limited conversation. We would have been talking about basically like rich guys buying and selling sports teams. It feels like the whole world has turned upside down. Democratization like we've never seen. What happened? Like, why are we here?
It's pretty awesome. First of all, good to see you, and thanks for having me. It's pretty amazing, isn't it? So we've had, I think the big story has been institutional capital coming into the space, and we'll get back to that in a moment. I think the first thing that happened was years ago, and this partially was driven by the likes of DraftKings and FanDuel, that you had young engineers coming out of MIT and Caltech and Stanford and Harvard deciding they wanted to go into sports. And they also, at that point in time, because people saw, the rocket ship that DraftKings and FanDuel seemed to be becoming, you had venture capital backing them. And so all of a sudden, the venture community for a long period of time effectively ignored sports. And so now, even though there's been a technology revolution for the last 20-something years, sports really hadn't participated. And now, over the last 5 or 6 years, you're seeing the fruits of those VC investments where you have all these innovative, disruptive companies who are now coming to the forefront, who are helping to monetize the interest that we all have in sports. And so when you all of a sudden have that dynamic, you have the financial profile of these assets changing, right? Because it used to be, as you said, a wealthy guy who, if at best maybe broke even with the team, but loved owning the team, and that was okay, right? And they went up in value because there's scarcity value and there's some tax reasons, blah, blah, blah. Now all of a sudden, you've got all those aspects, but you also have this disruptive, innovative technology that is changing the way these P&Ls look, and that's got the institutional investors saying, this is interesting. This is a world we couldn't play in before. We've always wanted to play in it because we love sports, but now I can actually point to some real growth that's based on secular changes that are happening, the way we all interact with the thing we all love in sports.
Right, and one of those secular changes has to do with regulation and sort of a new look at especially sports betting, which used to be kind of a dodgy, shadowy, call your bookie sort of situation. Now it's technology enabled, it's getting legalized more and more. And so help me understand that piece of the market, because that creates an ecosystem in and of itself in many ways.
Absolutely. So look, as you alluded to, sports betting's always been here, right? And obviously it's been around the rest of the world, and it's been here in an illegal way in the United States. With it becoming regulated, you're getting what I would consider to be much more concerted efforts to market to customers. You're getting technology that people can trust, and you're getting, most importantly, the leagues and the teams to buy in, right? So for years and years, the NFL, the NBA, baseball, they fought against sports betting, right? They had tons of lawyers really keeping PASPA in place. And the minute it flipped, all of a sudden you've got these leagues going all in because they all see what we see, that there is this 24/7 interaction with sports that people want to have, right? And it's through social, it's through group text and the like. One way to monetize that interest is to get people to bet on sports and to talk about it. And it used to be that if I was a Mets fan and they were playing on a Tuesday night versus the Astros, I could skip it, right? It's one of 162 games, not a big deal. But now, if I can real-time bet while I'm watching the game, so I get to kind of kill two birds with one stone. I get to follow the team that I grew up loving, but I also get to scratch that itch of getting a little bit of action. It's a win-win, and so the leagues have bought in. But importantly, what it's also done, going back to the original point, is it's increased the value of the data, right? So we saw this renaissance in sports where the media rights, and we all know the story, the media rights have gone up and up and up, and that's helped bring valuations up. My view of the world, and I think a lot of people share this view, is that we're in the first inning, to stick with the baseball analogy, of the data revolution, where you're seeing NFL, the NBA sell their data packages to the likes of Genius and Sportradar and others, and that's going to continue to go up. And you need that data for sports betting and other things, right? There's fantasy and there's NFT related items. Those data packages will get more and more value, and so we may just see a rinse and repeat of what we saw with media rights. And I think that's another thing that's got people very excited, because even though we all know the regional sports network model is messy and there's a lot going on there, if you have this other thing coming up the back of sports data that could frankly even be bigger than media, gets people quite excited.
All right, I want to come back to media in a second, but you mentioned two things that we can't move past before talking about them a little bit. Fantasy and NFTs. Let's start with fantasy, because that is, I think you and I both know anecdotally, and you know the data better than I do, that level of engagement that you have with the sport, and not just with your team, but with teams across the league, especially when you think about fantasy football, from my 17-year-old to my peers, they're engaged in this game, as you say, 24/7, picking a team, watching the scores, watching individual players. But how does that become investable in your mind?
So it's all connected, right? Because what the fantasy companies are able to do, right? Put daily fantasy to the side, right? Because I think what you're talking about is season-long fantasy, where you're in a league with your college buddies, and it's a great way to connect once football or baseball season starts. Those companies actually collect a lot of data about you, so they know, because that tends to be where you get your sports information. So they know the teams that you like, and you are somebody who engages, with their app on a fairly regular basis. And they are now figuring out they can sell you other stuff. I think you've seen with DraftKings, right? They actually launched their own NFT product. But this is why the daily fantasy guys, and to a certain extent, when you think about Yahoo Sports and CBS Sportsline was an interesting partner, and clearly ESPN is viewed to be the crown jewel. The betting companies want to partner with these fantasy companies because they have this data, right? And so it's a great place to look for potential bettors. But what I think we're seeing is, as we think about the entire P&L of the sports team, so not just the line that relates to data, but merchandising, collectibles, people are looking to season-long fantasy as a place where I can find out information about the customers, right? Because that's one of the things that people haven't realized. Over the years, the teams themselves don't have great data on who their fans are, right? Because most of the fans, they just watch on TV, they've got a cable package, and there's no real interaction between the team itself. It goes through multiple layers between the team and the consumer. Now with fantasy and these other things, they're getting direct data about their customer, and that allows them to market other products, NFTs being one. Collectibles, you've seen some of the announcements about some of the deals that are happening in that space. And that is creating massive opportunity for the teams. And it's not just, oh, this is nice, we're going to sell more people baseball cards the way Topps sold baseball cards. There's two other aspects to it. And this is really true for all collectibles. It used to be that, little Don Cornwell, when I collected baseball cards, I'd run around to these trade shows in the city, and I'd go and I'd try and find my rookie Dwight Gooden or Darryl Strawberry baseball card, and I'd pay some amount of money. Well, guess who never got any of that, right? Team, the league, the players. They got the original sale, right? Whenever somebody bought it in the pack with the nasty gum, but they never got the secondary market. Well, with these marketplaces that are being set up, the leagues are a part of them, right? They have equity, they've got deals with the likes of Fanatics, and so they'll participate in that. Right, so if you think back to the way it worked in the 70s and 80s, where there's all this activity happening in the secondary market, and the teams and leagues never got a piece of that. Well, guess what? Going forward, they're going to. Second thing I'd say, and this relates more to blockchain. You talked about NFTs. I could be somebody, and I am. I've got this massive card collection, and I have a lot of Mets. Right, so the Mets don't know that. Right, and they have no way of talking to me. They don't know that back in the 80s I collected a lot of Mets baseball cards. Well, imagine if they were all on blockchain and they could actually speak to the holder of that, right? And that's what the future is, right? Is that all of a sudden the teams and the leagues, if they can get their products on blockchain, that's why NFTs are so important, they can actually communicate with them and communicate with them directly and get data and then figure out a way to get them onto their system. So it creates an enormous amount of upside. We're just now scratching the surface of it. And going back to my original point about the venture community, you're seeing so much capital and so much human capital try to figure out this problem because they know the win is a big win, right? There's a lot of money to be made if you can get this done.
Well, and as you allude to, your card collection and, you name-checked a couple well-known stars, and I'm sure you've watched just a plug for a great documentary out there,
it's amazing.
Once Upon a Time in Queens, 30 for 30, the 86 Mets. I think about that team in a lot of ways, and looking at those personalities, whether it's Dykstra or Hernandez or Gooden, you think about who those players were and their businesses, which were really limited to their playing careers, versus athletes today who do have, like the leagues and the teams, a literal stake in what they're doing. How has that changed the investment landscape in your estimation?
Yeah, no, it's a great point. Name, image, likeness is a huge part of this, right? Because whether it's video games, whether it's NFTs, while I'm a Pittsburgh Steelers fan, I love the Pittsburgh Steelers logo. I also, love the idea of getting things that have Franco Harris on them or that have Jerome Bettis on them, right? And that's a name, image, likeness thing, and that goes through the unions. And what we've seen, and this has been the case for a while, right? The unions have always had deals with the video game companies, right? If you want to play John Madden football, you've got to go cut a deal with the NFLPA because you want to get the faces and the names. What the unions have done is they've set up these corporate entities. For NFL and for Major League Baseball, they have something called One Team. For basketball, they have something called Think 450. And they've brought in professional management people who actually know how to cut these deals, who understand these ecosystems. They understand NFTs, they understand video games. And they're the ones who are actually going and cutting the deals, and they're getting these great contracts. And so all of a sudden, you've got these revenue streams coming in. You've got a business that doesn't have much cost, right? You've got to give royalties back to the unions themselves. And outside investors are looking at that and saying, wait a minute, this is a backdoor way of me playing the same secular themes that I love about sports without having to deal with actually owning a team, right? I can go and so both One Team and Think 450, my suspicion is that they're getting lots of phone calls from institutional capital saying, how can we be in business with you, right? Any way we can be in business with you, we'd like to be in business with you. And that is something that I think will continue, and I think we talked about the other day with college. We're not there yet with college. It's going to come at some point. It's going to take a lot longer. It's a much more complicated discussion because of the way that ecosystem is structured. But there's no doubt in my mind that's something that's coming down the pike as well.
Yeah. Go back to the media situation for me, if you will, because as you say, like that was the that was the bread and butter. That was so much of what the intrinsic value, you know this much better than I do, of buying a team was the media rights associated with it, whether it was through a regional sports network or whether it was as part of a broader national deal. With different engagement, with social media, with streaming, how does that landscape change, and how should an investor think about that, since it's not maybe exactly the same landscape it was before?
Yeah, so it used to be every 8, 9, 10 years you had to go and negotiate your big deal, either locally or nationally, right? You'd call up NBC and Disney and CBS and and Fox, and you'd run this auction, and they're still doing that, and the NFL just did it very successfully. The NBA will do it very successfully in a handful of years, but with new entrants into the system, right? People like Amazon, people like YouTube Live, Fubo. All of a sudden, you've got DAZN, you've got these other folks who are streaming, who are saying, I want to be a part of this. But then you've also got the likes of NBC and Viacom launching their own streaming networks, whether it's Peacock or Paramount Plus or HBO Max. And so the real challenge and where the leagues are going to really earn their keep is figuring out how to make that transition. And what they're very good at is they're very good at chopping up rights. And you're seeing it now, the way the NFL has handled Amazon. They've said, okay, we've got this Thursday night package. It's always been a little bit of our softest package in some ways. Let's go experiment with that, right? Amazon, pay us a lot of money, which they did, and let's go do some things, right? And see what we can do with that. And what they're doing is getting smart. It's like paid R&D, God bless the NFL, where they can then, when the time comes, maybe it's 10 years from now, and it's no longer NBC and CBS competing, it's Peacock, Paramount Plus, and Amazon competing. They kind of know the tricks of the trade, right? And so while the landscape is changing, because the content is so strong, the dollars will be there, right? So as an investor, you may have to get comfortable that the management teams at the leagues can manage through this what I'll call era of change. But you know that the content is strong, so you know that the dollars will be there, right? I don't think the dollars are going away. I just think the way in which they'll come in will change. And I'll add one more thing to that. Because of all the stuff we've talked about previously around NFTs, merchandising, collectibles, imagine a world where you are streaming, and so there's a more direct relationship with the consumer.
Right.
And you can serve up. You know that I'm watching, right, the Knicks game, so you can serve me NFTs, right? I watch the Knicks game. There's an amazing play in the third quarter. I turn the TV off, and next thing I know, I'm getting an email, right, with an offer to buy an NFT of that game, right? And that's not something that used to be able to happen, but now in the future we'll be able to do that. And I think that's where this is getting super exciting. I think a lot of the investors are getting stoked about what the future might be.
Yeah, see, I would want the Trae Young shot, and so that is just like I just made myself very unpopular with all the Knicks fans out there. So, too soon, right?
You got a lot of New York people here. What are you doing? It's the season starting. We're all optimistic. You're bringing back
that thing. Not good for my career. Not good for my career. Just as we wind up, I got a quick question from the audience because we didn't talk a lot about leagues and teams, but soccer is professional soccer. The MLS specifically is something you and I have talked about before. How has the development of soccer in the U.S., how is that changing the valuation considerations? What have you seen there that may be indicative of the broader landscape?
So values are going up. There's no doubt about that. I think, people like to just look at the ratings numbers and say, well, there's not that much interest because the ratings aren't going up. That's not fair, right? Because when we look at all the sports, ratings are getting hit hard. What you have to look at is actual engagement. And for me, the first thing I look at is, well, people go to the games. And when you look at what they did in Atlanta a few years back when they opened up the stadium, and not just some small, 20,000 person stadium, they opened up the football stadium and they were selling out every game. That tells me that there's engagement, right? And when I, go out where I live out here, there's a bunch of soccer fields, people playing soccer 24/7, right? We know that the interest is there. And I've been saying it forever that it's going to catch up, right? There's no reason why it won't catch up. And we're starting to see is that interest in getting there. And I think the other thing is, and it goes back to what I was saying earlier around the way to monetize. It may not be that MLS is going to monetize in the near term with some big, huge TV contract, and people should stop waiting for that. But are there other ways for them to monetize? And the answer is absolutely yes, because they've got that engagement, and now we know how to monetize that engagement. And so, I see a lot of smart people going and putting money into MLS, and I think, they're spot on for doing it.
All right, 1 minute left. What's the sports story, the sports business story that we aren't talking enough about out there that's crossing your desk or you're emailing or texting people about?
You know, and I had to end on a Debbie Downer, but I will because it's true. I think sports betting has taken on, while it's clearly an enormous market opportunity and something that we're very focused on and will be, but people are somewhat treating it as if it's this disruptive technology, but it's not, right? We've been sports betting forever, right? It's just that we've now regulated a market. So it's a new market opening up, but it's not disruptive. I think the thing that makes me nervous is that when you look at some of the rest of world markets like the UK, there will be regulation, right? And there will be problem gambling. And I think we as responsible sports people, businessmen, have to understand that. And we have to make sure that we're being responsible. I think the betting companies are being responsible, by the way. I think I've been very impressed with the things that they're doing, but I think we all need to, keep that in front of us, that we don't sort of lose the plot, that it is gambling, right? And we do need to make sure that we protect those that may not be able to handle it the way they should be able to.
All right, good thought to end on, thinking very holistically about this business that you and I love so much. Don Cormo, really good to catch up with you. Lots more to talk about as always, and see you at the Super Bowl in LA.
See you at Super Bowl. See you in LA, man. Thanks.
All right, thanks a lot.
Welcome back to Invest. I'm Guy Johnson, one of Bloomberg's television anchors, and I have the great pleasure to be joined for the next 20 minutes. We have the great pleasure to be joined over the next 20 minutes, as I should say, by Luke Ellis. Luke, of course, is the CEO of Man Group. I checked their website. According to the latest figures, and I'm sure this changes on a fairly regular basis, $135 billion under management. That number puts Man Group firmly in the upper echelons of the hedge fund world. We've come out of a bumpy September. We're into what looks like a fairly bumpy October. Volatility, you would have thought, would be the friend of the hedge fund, but let's find out. Luke, great to have you along for the next 20 minutes. I know your schedule is incredibly busy, so thank you for your time. I know you're out and about seeing clients once again. What are you telling them?
So I think people are, the short-term bit with the volatility we've got, people are trying to work out, clearly the sort of growth it's still positive, but the first derivative of growth has rolled over and has gone negative. So growth is slowing, and it's hard to work out what the right level for growth is looking forward. Inflation, the first derivative, hasn't slowed down. It's still seems to be quite, and so clients are really trying to work out, their basic positioning has been to be max long equities. Wherever you talk to clients around the world, they're all in whatever is the most equities they're allowed. And so we're sort of talking to them about how do you manage that risk if growth is going to roll over, and even more importantly, what do you do with your bond allocation if inflation is here or is here for long enough to scare the central banks into some real action?
Okay, let's unpack that for a moment. In terms of the equity outlook, what are you seeing? What do you expect will happen now? As you say, maybe the liquidity element of the rally is now done. The growth element maybe is starting to fade. Where does that leave equities, do you think?
I think, assuming that we don't get some shocks, either from the Chinese situation, which, if Evergrande spreads into a broad problem for all of the house building, house owning, it's like 25% of the Chinese economy. So, if that spreads, that's a significant problem. Or if inflation scares the central banks into actually raising rates in the near term, that would be a problem. But otherwise, personally, I think, we're getting a bit of a shudder here, and then we will start another march quietly upwards, not at the rate we saw for the last 12 months, but if we've got reasonable growth equities, that they are in the end, Tina, they're the only alternative for most people.
You say that they are the only alternative, but most people, as you say, have to have some bonds in their portfolio. Most people hate their bonds right now. What do we do about that? If government bonds are going to be problematic for quite some time, and it looks as if we're going to find ourselves in a situation where potentially yields are below inflation, negative real rates for quite some time, what's the alternative? What else do you do in a portfolio to provide that kind of counterweight without being in govies?
Well, I think this is where hedge funds should come into their own. Look, there are a number of things which you can look at, but at heart, what you've described is this problem that government bonds, they don't provide a stable store of value, particularly if you're worried about inflation, and they don't give you any income. I mean, literally none in many countries. And so they don't really fulfill a function in a portfolio, the stabilizer or the income, or they're not really doing something useful. And so I think you have to look at bonds really as a trading instrument. There are opportunities to make some very good money out of some of the rallies and also some of the sell-offs that, and maybe we'll get more sell-offs and there'll be an opportunity to make money out of being short. But just sitting long bonds feels like the wrong answer. And so either you've got to find active credit strategies, which at least can give you some carry and an opportunity to get in and out of interesting names as we get developments on the growth side, or you're looking at alternatives. And this is, at heart where the basic hedge fund industry came from, is an alternative to long bonds. And, I think the hedge fund industry has done a good job in the last 18 months of showing that, can ride through the storms and deliver, it's not miraculous returns, but it's solid, steady returns, which compared to bonds looks pretty attractive.
So what does that look like in terms of constructing that? As you say, there's a whole sort of series of alternatives that come in. I'm sure some of it's public markets, I'm sure some of it's private markets, but just give a kind of an idea of what that option looks like. If you don't want to be long government bonds, if you want something that looks that provides a similar objective or has a similar objective to that, what does it actually look like? You talked about the sort of the credit portfolios, but kind of walk me through. If I was a client and I came to you asking this question, what would we be talking about?
Sure. Well, so I think the first thing is to exclude all the things which are effectively long economic growth, because that's what you get from equities. So you can choose private equity relative to public equity. You can debate which gives you better value at any one point, but they are essentially the same risk. So, when people move to private markets, it's for the hope of a pickup in yield. But, while you might get a dampening in mark to market in private equities relative to public equities, it's the same risk, right? It's long growth. And also some of the sort of lend and hold strategies are also, again, really about being long growth. So you're looking for the things which are not that, right? So you're looking for market neutral type of strategies. You're looking for diversified strategies. And we think there's a lot of things with the volatility you've got in markets, it's making them more inefficient. That's creating some nice margin for people who are, playing on efficiency. There's good stock picking returns and credit picking returns to be had. You just have to be careful of sitting long something and holding it forever. So, there's no point going into a hedge fund strategy that's 60% net long equities all the time, because that is correlated to equities by definition. You're looking at the stuff that's not correlated to equities, and that's the starting point, because that's what you were aiming for from your bond portfolio.
That's an incredibly small group, though, isn't it, at the moment?
It's not that many names, but they tend to be able to run quite large amounts of capital. They tend to spend a lot of time and energy on their risk management and on their execution. Look, it's obviously something we do. So I'm trying to be generic here and not talk about what we do and talk about. But there is a number of opportunities for this within the hedge fund industry. Can that replace all of bonds? No, of course it can't. Of course it can't. But I think clients are looking for help on their portfolio rather than trying to solve the economic problems of the world. They're looking for something. If you think they used to think that they were getting 2 or 3% real returns out of their bonds. and hoping for more than that out of equities. Clearly it's a struggle to get anywhere near that. So that's where hedge funds come in. And it's also where a number of the sort of the income type strategies in private markets come in, where you can get a number of things with long-term inflation protected cash flows. And those are also very attractive to people when they recognize what they were looking for from the bonds.
Let's back up a little bit and talk about some of the other things you raised at the beginning. The volatility that we're seeing at the moment, do you think that we are heading into a higher volatility environment? I think the average on the VIX going back to, it's just one metric, of course, and there are plenty of others, but I think the average on the VIX is something like 19 going back to the beginning of the 1990s. I think we're trading sort of circa 22, 23 at the moment. Where do you see the story going from here? Are we entering a more volatile period? Clearly, we've had volatility suppressed by central banks, but I'm wondering whether or not, as central banks look to exit current monetary policy, whether or not we do see volatility pick up. And if so, where are the opportunities there?
Yeah, I think that's a very good way of thinking about the problem. And what you did, which is important, is to look at the VIX all the way back to 1990. People have a tendency to think about the last 10 years until COVID and think that was a normal environment. And the reality is, equity volatility was very low during that sort of 10-year period post the financial crisis before COVID. Why was it low? Because you're right that the central banks had dampening policies, but actually, more importantly, every central bank was following essentially the same policy. Every government was following essentially the same policy. And so you had real lack of volatility in economic outcomes. You had a very monothematic market. And so it was a very low vol period. I think that has broken firmly. You can sort of question whether it was COVID that broke it, or maybe it was a bit earlier with some of the economic policies that government started to follow. But, as we've gone from what's been a pure monetary world where, sort of central banks were controlling governments into a fiscal world with central banks essentially being the tail on the dog from governments, then you naturally get a lot more volatility in economic outcome, and that creates more volatility in markets. Generally, it creates more volatility in stocks because, government policy is starting to interfere with stocks a lot more. That creates opportunity, that creates stock picking opportunities, good and bad, right? I mean, I think that's one of the things is you can see winners out of some of the changes in government policy at the moment. It's very easy to see losers in a number of things. And so, it's where a long short type of thing helps. But if not, if you're long only, you just need to know what to avoid so that, a change in government policy doesn't take you out.
Let's talk about government policy. It's interesting. We have a hearing on the Hill today talking about Facebook. It's going to be interesting to see what regulatory changes come about as a result of that. But the biggest kind of obvious, most clearly defined interference by government in markets has been in China. What do you make of what we're seeing there? Does it change your attitude towards China? China's very hard to avoid if you are simply investing in indexes, but what is your attitude as a hedge fund towards how the situation is changing?
Look, I think if you are investing in markets, it's impossible to have no view about China. It is too big a portion of the markets out there. It's too big a portion of the global economy to ignore. So you have to have a view. And I think the bid in China is to work out where there are financial opportunities and where they are going to be curtailed by government policy. In China, they tend to be more explicit. I think, we went through a period in the West of deregulation for 20 years, 30 years. I don't know, it was a sort of a long train of increased deregulation. Increased regulation started coming to financial markets after the financial crisis and has been coming to a lot of different sectors and more in the West. So what China is doing is quite explicit, but it's not that different than what we see in a lot of the Western markets. So I think what it means is you have to be lighter on your feet. You holding something with a 10-year view really doesn't make sense in a world where you get these interventions, where you get significant changes in policy. And so, I think what it requires you is always to have let's put it this way. We would always say have liquidity in your positions. If you don't have liquidity in your positions, then you need to get a significant premium for the fact that the tail risk from interventions is significant. And, you know, we've seen some of those numbers in China being really quite significant. Our view is it carries on. You know, the Xi Jinping, you know, one of the things is he changed rules so that he can be re-elected for longer and longer periods. But he hasn't yet been elected for the next period that's coming up in sort of the next year. And so it's really important for him that, you know, he has the party on his side for that process. Who knows exactly how it happens within the Chinese Communist Party, but there is a process. Yep. And, you know, it's important to him that he comes out on top of that process.
In that, as that process unfolds, is China investable, or are the risks, because they are quite hard to define, make it significantly less attractive?
I think it definitely makes it less attractive than it was a year ago. You can see, you know, the trends which people were taking advantage of, the big winners in the tech space and some other spaces, you know, those have been broken. And so now you have to invest in the knowledge of, you know, this sort of shared prosperity idea that they have in China and how that's going to affect things. And, you know, you need to make sure that the things you invest in are on board with the government, sort of the zeitgeist of what they're trying to achieve. That creates some opportunities, and it definitely creates some shorts where there are many companies which the market hasn't yet worked out are really not pulling the way the government wants them to pull.
Look, you've painted a picture of needing to be nimble in a number of different asset classes, in a number of different geographies. Do you think most large funds, though, are built for this? I appreciate this is something that you would try and certainly help them with, but most supertanker-sized funds move very slowly. How do you think they're going to perform in this kind of world?
Yeah, I think that is very important. When you look at the large end investors, the large pension plans, even the sovereign wealth funds in the world, they tend to have very slow-moving asset allocation processes. And that is natural because of the bureaucratic nature of their trustee boards and the organization structures. They're all slightly different, but they end up with fixed strategic asset allocation, a tactical asset allocation that allows a little bit of freedom, maybe then some sort of adjustments the CIO can make, but they're all at the margin. And, you know, the strategic asset allocation takes a long time. So we're certainly having a lot of conversations with sophisticated large plans who recognize in this world looking forward as opposed to the one looking backwards, that starts to feel uncomfortable. And they're looking for ideas of how someone can help them to manage those risks without wanting to, you know, you're not going to take a $100 billion pension plan and suddenly swing the exposure around week to week, but you can over time make significant differences and make a significant improvement to the overall return. You know, they all have a rebalancing process. Sorry, go on.
How much? One of the things they are certainly trying to do is green their portfolios. ESG is obviously a huge part of the narrative right now. In terms of how that again fits with what you're talking about, these large funds are very slow moving, but they need to make this transition. We're moving into a world which looks a little bit more volatile, and we're still trying to understand what exactly is green and what isn't green. How much of what you are doing right now and the conversations you're having have to have that part of that conversation? Have to have, even in a world where inflation is focusing people's minds onto the energy sector, has to be part of the narrative that you're talking about. And how does a hedge fund and ESG work hand in hand?
So this is, I think we've passed in the ESG front the place where most clients, you have to have ESG involved in the conversation. Right? We're past the point where you could say, oh, can I talk to you about ESG? And they go, oh, that's new. Now, everybody understands this. People have different views about how it applies. But I was talking to one public fund in the US who was talking to the CIO about how they came up with a plan, because there are local politics to deal with who, you know, have particular views about how they should react. But at the same time, you are saving, for the long-term savings of teachers, firemen, whatever, even journalists, broadcasters. It's long-term savings. If you're saving for people for 20, 30 years, which is sort of the timeline the average pension fund is looking at, they have to think about what the world will look like when you actually pay off the savings. There's no point having a load of money if the world that you've saved into, actually the money doesn't help because you're not able to live where you want to live because the temperature changes happen so much. Yep. So clients are expecting inclusion of ESG. I think we're now moving to the next phase where they're asking, okay, what can you do with a portfolio that will actually help reduce the climate change that we're all worried about in the world, will reduce the warming in the world? And so that is, we're moving, I think, rapidly to the next stage where clients want portfolios to have a positive impact over a long-term timescale for how do I actually help fund a world that stays below 1.5 degrees of warming. Yep.
Well, it's certainly going to be a big focus as we approach COP. That is certainly going to be the story over the next few months. Luke, it's always a great pleasure to spend some time with you. Thank you very much for sharing so much of it with us today. Man Group's Luke Ellis.
It's a pleasure. Thank you.
I'm Mervyn Davis, the non-exec chair of LetterOne, which is very much a long-term investment company founded by Michael. Great for us to be here. Great to be here today. Michael, you've been a long-term investor for a long time, dare I say. How do you add value to companies that you invest in?
I think our principal distinction from private equity type of investment would be that we are long-term investment, as you mentioned. So we do not have any particular time horizon for our investment. We're free to invest money for 5, 7, 10, 15 years. And we are looking just for development of the company. And we believe that we should be investor in the company until the company reaches a certain stage, which we call institution.
And, when you look at supporting management teams, how do you avoid being too controlling and stifling innovation and their leadership? How do you get the right balance?
Yeah, that's a good point. I think to build an institution without building the first-class professional independent management, just impossible, definitely. And therefore, for us, it's very clear distinction between the role of the board and the role of the management. I would like just to recall the one important quote from Thomas Jefferson, who once upon a time, when he was a Vice President of the United States, and him talk about the Senate, and that the Senate should resolve very few questions very slowly, but with a very high quality. And that's, to rephrase it, it's very relevant to what we are doing in the company. I think that we should, as a board, should be focused on a very few important strategic questions, not so slowly because the time has changed and the world is moving much faster than it was in the 18th century. And with a very high quality. And effectively, we are focusing on a strategy, which is rather principled than a concrete decision, and a key appointment. So we are would like to find those who capable to take the whole responsibility of the development of the company.
Culture is, I know, having worked with you now for many years, culture is very important. And what are you looking for in managers? Because they've got to be leaders, they've got to be able to build a culture. That you see as a key ingredient in this fast-changing world.
Yeah, I think actually, as I said, boards should be first of all focused on principal issues, and this set of principles create a kind of concept. And the concept, of course, steadily evolves somehow. And history of evolvement of concept create a culture. So we are looking for the management, those who really could build this culture, evolve this culture, and also preserve this culture for years ahead.
I've seen it personally. You've worked in so many different industries. Does it matter which industry? You're looking at people, strategy, culture. So, irrespective of industry, does it matter which industry?
Yeah, I think actually it's a lot of commonality in different industries and different type of businesses, because in the end of the day, businesses is just, my guess, repercussion of the human nature. It's a repercussion of human incentives, interests, needs, and kind of desire and so on. On the other hand, changes of the world, which is right now going, as I said, very fastly, have enormous impact for each particular industry, quite specific. Some industries have more influence from this digitalization of the world, some less, and so on. But anyway, so we need to have common approach to the principle for each of that industry. At the same time, we should understand trends and tendencies in each particular business. And that combination would be the most important balance we should achieve.
We're seeing technological change, we're seeing climate change, we're seeing lots of things happening at the same time. Do you think it's faster period of change than before, or do you think it was always like this?
The world always has changed, but right now, because of new technology and because of definitely invention, which mankind did within the last decades, I think the speed of changes increased significantly. So therefore, the key principles of the management in any businesses should be ability to react for the fastly changing world, and let's say reactiveness and also flexibility. So these two common features for all businesses we are investing.
So I think the message from Michael from LetterOne is an ability to adapt, to be flexible, to change, but also for boards to focus on a few key items and then develop that thinking. We're in a fast-changing world, and irrespective of industry, you need to move with speed, and you need managers who build great cultures. Thank you very much.
Thank you.
Hi, my name is Eric Balchunas. I am the Senior ETF Analyst for Bloomberg Intelligence. I manage a team of about 4 people. Hopefully we're expanding very soon as well, that cover ETFs, mutual funds. We even cover SMAs and closed-end funds, but largely ETFs and largely in the US. And so I want to go over with you today just some of the themes that we're thinking about, some of the topics we keep writing about, and some of our calls that we think are important for people to know. So with that, I'll get right into it. This is the Institutional ETF Outlook. And the first thing I want to go over really is ESG ETFs. There's been a lot of hype around this area, as you know, but we think they're going to face hurdles. While we think ESG as an additional way to analyze a stock, in complementary to fundamental metrics, is here to stay. We think that's definitely happening. But we think an ESG ETF as a product is just going to face some hurdles in the future in terms of asset growth, and we don't see it getting beyond 5% market share. And here's why. Here's a bunch of ESG ETFs, and here's the stocks they exclude. And you can see here, it's really a very subjective process, and we think that subjectivity is ultimately going to hurt it. Is Amazon ESG? Is Berkshire ESG? By all accounts, no. Is Apple there? And then the weightings are different. I think it's very active, and to put this into the core of your portfolio is making an active decision and requires a lot more due diligence than it looks like you need to do. In addition, companies like Tesla, is Tesla ESG? If you ask 10 ESG analysts this question, you're probably going to get 5 who say yes and 5 who say no. Like that, it's not in every ESG ETF. It's in a lot of clean energy ETFs, but it doesn't make it into every single ESG. So they'll say Tesla is good on the E, okay on the S, and horrible on the G. And so that's sort of what you're looking at here. And with ESG, the company's either in the fund or it's out. You're going to throw babies out with bathwater, and you're going to keep bathwater with some of the babies. And you're going to have to live with that And again, it's just so subjective. And one of those moves could really change your performance. And we just think this is going to make it difficult long-term for the assets. There's also been a ton of whistleblowers who have come out, both from BlackRock and DWS, basically saying, hey, there's a lot of marketing going on in this. And that's giving it some baggage. I think it's making it a little more controversial than just, oh, hey, let's save the world by investing in these funds. And then Gary Gensler of the SEC is looking into disclosure and marketing of ESG. So that's something that could affect their growth as well. There are some unique ESG ETFs. I won't go through all of them here, but engine number one is interesting. They do activism. So you hold the whole S&P, but you just basically have them try to get bigger institutional owners to vote in an ESG way. Just is interesting because it looks at more how corporations pay employees as opposed to climate issues. And then the fossil fuel we like, it's just the S&P minus some energy stocks. And I think that's a clean way to just basically, if you're not into energy, to do it. And there's some other ones over there that complement the core. That's the big thing. If you have a Vanguard fund in your core, it's very difficult for an ESG fund to displace a 3 basis point total market fund. However, something like clean energy or solar energy or uranium or the new one from ARK could complement that core. And so we're a little more bullish on those. Speaking of which, uranium, I just want to say this is a story that we've been tracking for a couple of years, and it's really interesting. We call it green investing for realists. We think that uranium is going to be a big deal because nuclear is going to have to be part of the solution. If people want to keep up their lifestyles and emerging markets want to use energy as much as we did as we became a rich nation, you're just going to have nuclear. That's what a lot of people are, realization a lot of people are coming to. And you can see it in URA and URNM. Look at the flows and the volume. These things have really broken out and become legitimate ETFs with a lot of liquidity. Okay, ARK. ARK isn't going away. There's some thought that, it's the Janus 20, Cathie Wood's going to come and go. We don't think so. If you look at our flows of ARK, you can see it's in and out. And so since the 25% drawdown, ARK's having a tough year. There's really not been a lot of outflows net. There'll be a month or a week where it's not good, and then it'll bounce back. But largely, her investors are hanging tough. And the reason for this is because portfolios have changed. If the core of the portfolio is now dirt cheap beta, thus what people want is something to add on top of that. Call it hot sauce or shiny objects, whatever. We have a bunch of phrases for it. And so she's in that lane, and ARK is in that lane. And if it's not your core, you're not going to panic as quickly. So we think the tolerance to withstand underperformance in ARK is there. It's the middle that's tough. These are funds that are sort of lower active share and charge over 40 basis points. A lot of the legacy mutual funds are there. The active non-transparent mutual ETFs are there. That is struggling. The middle is not a good place to be right now. And if you look at ARK, a lot of those companies on the right, they serve stuff in the middle. And you can see the outflows. ARK's taken in $35 billion in the past 2 years, whereas all other active equity mutual funds have lost $800 billion. It is really bad. So just the fact that ARK could succeed was a minor miracle, but now we kind of get it looking back. High active share active is probably going to be the new viable lane for active unless they're willing to go really cheap. A Bitcoin ETF will likely be approved in October. This is we think there's probably a 70-75% chance this is true. If you look, here's the funds that have filed. The reason we think a Bitcoin futures ETF is probably going to launch is because they're all going to be filed under the 1940 Act. Gary Gensler has said he likes this act. There's more protections under it. And since Bitcoin isn't a security, you have to file futures. You can't put a physically backed Bitcoin ETF under the 40 Act. And so all the physical ones are filed under the 33 Act, and we think they're going to be on ice for a while. We do think the futures will launch. And look, there's a ProFunds Bitcoin futures mutual fund that launched, and that was filed and launched 77 days after it was filed. Thus, if we look at that as a template, that puts the ProShares Bitcoin strategy on pace to be approved and launched in mid to late October. And so that's the lineup of funds you hopefully should expect to see approved. It's possible they delay them again, but given everything Gensler said and some of the things we've seen, we're pretty confident they'll approve these. And look, there's that mutual fund I talked about. There's a possible bad sign. The mutual fund was largely ignored. This tracks Bitcoin futures too. We don't know if it's because people don't want mutual funds. As I said earlier, they're not exactly the most desired wrapper right now. Or is it because it holds futures and people want the real thing? We'll see. The thing with this fund, though, it tracks pretty well. And there was some worry that holding futures would not track well because of the roll costs. So we think the roll cost might be 3 to 5% a year. It's not great, but it's not horrible. But we'll see. We think maybe 10 to 20% of the demand for a physically backed Bitcoin ETF will be there for the future. So it'll be a moderate hit, we think. We'll see. Mutual fund ETF conversions will grow. This is my final section here. When we think about the mutual fund, how are mutual funds going to adapt when all the money is going to ETFs? This year, ETFs are going to take in probably $800 billion, and mutual funds will lose a couple $100 billion, especially on the equity side. It's pretty bad. And we think they're going to convert to ETFs. This will be a more popular way to do it. There's already been about 12 conversions, including DFA, JP Morgan, Guinness Atkinson, worth about $50 billion. We think there's going to be $1 trillion worth of conversions in the next 10 years, and it will include hundreds of mutual funds. That said, that's still only 10% of all mutual funds. We think there's some that have deep 401k, penetration that you really can't convert. It's going to be too tough. But we're bullish on this because when you convert a mutual fund to an ETF, you come over into the ETF world with assets, a track record, a little more dignity, more weapons. And if you don't, and you clone yourself and launch a new ETF, I mean, you're kind of like putting a baby into the jungle. It's so brutal. And it's hard to compete with no assets. And again, if you're serving something that's benchmark aware, semi-expensive active, it's almost impossible to get flows. And what's interesting is there was a cannabis ETF, a mutual fund that recently converted, and that mutual fund outperformed all the cannabis ETFs, but nobody bought it. So here's a case where the mutual fund was like, look, I got to go to where the fish are biting. So it converted to an ETF just this week, actually. And it's smart. I mean, what else are they going to do? And so I think more mutual funds will come to this conclusion over the next 5 or 10 years. That said, there's multiple options for them to do this. They could launch a clone of their mutual fund. They could convert, or in 2 years, the Vanguard patent on making an ETF a share class of your mutual fund expires. They have a special patent on that, but that will open up. So in 2023, it's possible many mutual fund companies will simply launch an ETF share class of their existing fund, and therefore they can benefit in the tax efficiency and other things without having to convert or launch a new ETF. And so with that, those are some of the themes we're thinking about. If you want to reach out to us, that's how you can get me on email or follow me on Twitter at Eric Balchunas. And I thank you for your time today.
I'm Alex Steele here with a very special guest, John Gray, Blackstone president and COO. John, and you're in person. This is like amazing.
I love this. So much better than the Zoom screen.
We actually had a real conversation before this. I actually want to pick up on what somebody said earlier in the sessions, that Bruce Flatt said that now's a good time to be liquidating assets. What do you think about that?
Well, I think for stabilized assets, markets around the world have been pretty strong. So obviously rates are low. There's a lot of liquidity. So we have, like others, been selling assets. But I don't think you're necessarily saying this is the top of a market. But I do agree that generally it's a good time. Markets are liquid, so exiting makes sense.
Is that different, though, than calling a top?
I think so. I mean, look, we're at an interesting transition point. Everybody's starting to focus on inflation. And with inflation and the Fed getting close to tapering, to buying less bonds, long rates may very well go up. And that can put pressure on asset prices. And so people are looking at that and trying to position themselves. But on the flip side, the U.S. economy and the global economy is pretty good. So I'm not certain. I wouldn't say, hey, I want to take a really defensive posture. I just think you want to be thoughtful about the types of assets you invest in, the types of assets you hold.
So let's get to it.
Yes.
What are they?
Well, I would say a couple things. I think the biggest thing is in this kind of environment where rates are likely to go up on the back of higher inflation, what you don't want to own is long duration fixed income, because there you're more vulnerable. There's no place to hide. What you want to try to own are businesses and assets that can grow. And even if multiples come down, value can increase because of the growth in cash flows. And so for us at Blackstone, we've really tried to be thematic investors. Look at some of these huge changes that are going on around the global economy and how can we benefit from them. they would be things like the movement of everything we do online. So shopping, paying for things, entertainment, healthcare, education, all of that. So we've invested in businesses like Bumble and Ancestry, but we've also invested in businesses that are one derivative off: digital infrastructure, data centers, fiber to the home. We've been the biggest investor in the world in last mile logistics, warehouses, based on that e-commerce boom that's underway.
But you guys were already doing that before the pandemic.
We were doing that before the pandemic, but if you look at these trends, look at e-commerce, it's gone from 0 to 20%. It's probably going to go from 20 to 40%. I'd say the same thing about life sciences. That's been accelerated by the pandemic as well. But big data, genomics coming together, mRNA, immune therapies, all of this. So invest, sort of beaker to bedside. Invest in the buildings themselves, invest in companies running trials, invest in promising therapies. How can you take advantage of what's happening in a market? I'd say this about green energy as well, wind and water and solar and all the infrastructure that goes with it. And then I would say some of these big thematic areas are not necessarily technology driven. Could be global travel, rising middle class in places like India, alternatives, housing. We've had a real shortage since the financial crisis. And so as investors, when we think about deploying capital, we say big picture, where are some of these really attractive, good neighborhoods we like? And then how do we flood the zone there? How do we express that in a bunch of different asset classes?
So I have to think, though, that a lot of people are going to try and flood those zones. And just today, JP Morgan Asset Management said, look, we can have higher rates, but real rates still stay low. You need to go into alternative assets. You need to go take on a little bit more risk to get that yield. I mean, there got to be a lot more people invading your space.
So alternatives definitely are coming of age. There's no question of that. But their scale is still pretty small. So today our industry's, I don't know, $7.5 or $8 trillion, which sounds big, but stocks and bonds are $250 trillion. And what we see investors doing is not necessarily taking more risk, but they're trading some level of liquidity for what they believe will be higher returns. And the data looking backwards has shown that. And so in our business, if you look back a decade ago, we were basically in private equity, real estate private equity, distressed credit. That has broadened pretty dramatically over time as we move into things like core plus real estate, infrastructure, direct lending, structured credit. And the people we can serve, the pools of capital have broadened beyond just traditional pension funds, now to insurance companies and individual investors. And the types of assets we can buy have broadened a lot. And we've compared this to basically a ship that was operating in a very narrow channel, moving into much more open waters. And that means for our industry and our firm as the leader in this industry, it bodes pretty well. And so we're very optimistic.
But as you have rates go higher, does something like direct lending get riskier?
Well, direct lending tends to be floating rate. So we're lending to companies that are non-investment grade. They're often in transition, so they're borrowing floating rate. I think the risk in a higher, certainly the risk in a higher rate environment is long duration fixed income. So being a direct lender, we have a non-traded BDC that serves individual investors. It lends to companies on a floating rate basis. So if the Fed, in response to inflation, starts to raise rates, that's obviously beneficial to this kind of product.
Meaning that you don't think there's going to be a default?
Well, not necessarily default, meaning the return goes up. So
sure, but underlying company, they're not going to see a default cycle like we might have seen otherwise.
Yeah, I think the risk of the environment we face today is not an economic slowdown. It's a bit of overheating. As we come out of this COVID hibernation, I think the risk is we see real economic strength. That's what we're seeing. Virtually all of our portfolio companies are seeing revenue growth. We're seeing very little in the way of defaults out there, record volumes at ports. We're seeing strength in housing. So broad-based economic strength. The risk is that rates move higher. So if you lend to companies and their credit worthiness is improving, but you get paid more because you get paid, say, 400 over, and the base rates move from 25 basis points to 125 basis points, you're earning more as that lender. So if people need exposure to fixed income, I think you want to err towards floating rate securities.
So that would imply also that the companies have the earnings and the growth to match whatever payments, et cetera, which means that it doesn't seem like then you expect a stagflation scenario, more of an inflationary one.
I would say in the near term, no. I would say when you look at all the savings that have been built up, you look at various elements of the economy, you look at the fact that there's sort of this global cabin fever you and I were talking about getting out there. I think we're going to see strong numbers, revenue numbers for most companies. The risk is input costs, certainly financing costs, but now wages, commodities, rental housing costs. That's the risk to companies' earnings, that their input costs go up. I think their revenues will be pretty good. And I think we've got some runway here in terms of revenue and economic growth globally for the next couple of years as we come out of this. At some point, we'll probably revert again to a lower growth society around the world. But near term, I'm more worried about an overheating. And I think that will put additional pressure on the Fed and other central banks potentially to move a little sooner than people may have thought 3 or 6 months ago.
Yeah, speaking of, I haven't eaten indoors yet. I refuse to eat indoors in a restaurant yet. I know it's crazy and weird. Do you think then the Fed could be on a policy mistake?
No, I think, look, the Fed has a very challenging position because there are still parts of the global economy, the U.S. economy, that are weak. In these cities, people haven't come back. We have supply chain challenges. There are certain industries that remain under pressure. And so they're trying to run a fine line. I think the risk for them is, as inflation spreads and becomes more pervasive, do they need to course correct? And I think there's a potential they have to do that. I'm happy I have my job, they have their job, but our overall expectation is one of pretty good economic growth, but higher rates, higher inflation, and again, try to buy and invest in companies and businesses that can do well in that environment.
Let me pick your brain on China for a second. Amy from HSBC Hong Kong sent in a question. And one of the questions was, can we buy the China market in the dip right now?
You know, we're not as much public market, should I buy stocks or not? But I would say extrapolate. What I would say is long term, China will continue to grow faster than most of the developed markets. They've got a very entrepreneurial culture. They've got a government that wants economic growth to improve quality of lives. And so I think that means, broadly speaking, China should do well. Now, I would note, of course, as we've seen over the last 6 months, that there are industries and sectors that are more sensitive. So if you think about education, you think about healthcare, you think about housing, things that impact lower and middle income Chinese people, those are areas you have to be more selective. The same thing around some of the businesses that have a lot of consumer data. But broadly speaking, as China has traded off, I think it could create some interesting opportunities.
How do you find them? Where's the spot when everything seems to be maybe at risk from government oversight?
Well, there are plenty of companies that are in different businesses that could be consumer facing in, say, restaurants or leisure activities. We've been investing in real estate in China, warehouses, office buildings. Again,
is there contagion there from Evergrande, or is the Evergrande thing just totally a housing property thing?
I think it's much more housing focused because that's where the big development companies have the mismatch. And there, I would say, in terms of contagion, I would think about it more as something that will impact institutional global investors in the high yield market. Domestically, I think they'll protect their local banks. They'll protect the individual homeowners. So I think it will have a knock-on effect. Those companies will have a higher cost of capital. They'll probably slow their development pace. But I don't see that spreading to something that's systemic within China.
What about outside of China? I mean, has the turbulence there created some opportunities for you guys elsewhere in other countries?
You know, I think markets, when they trade off, and we're looking to deploy capital, that's helpful. One, it reduces asset prices, but two, it reminds sellers that asset prices don't keep going up. And so
we forgot that.
Yeah, you forget that for time when you get lulled into a sense prices go up every day. And so, you know, that can motivate a seller who could own real estate or infrastructure or a tech company or somebody to say, hey, look, I want to sell a piece of my business. And so for us, we're focused long-term on delivering for our customers, delivering outstanding returns. And so when markets sell off at times, because we have long-term capital, we can move into dislocations, deploy capital, and then over time, when markets are more receptive, think about exiting. And so we look at it and say, if there's a particular market that's fallen out of favor, that's something that could create opportunity.
Is there one right now geographically?
Well, I think the UK has been pretty interesting for a while. That was a place where Brexit and then COVID created some opportunity. We've been very active there. Certainly, we talked about China could create some opportunities because in the tech sector, there's been, and broadly, foreign investors have become more cautious. I think interest rate sensitive sectors could create opportunities. Real estate, public market investors tend to throw the baby out with the bathwater. And within real estate, yes, if I own a 20-year leased office building that looks and feels more like a bond, then yeah, maybe I want to be cautious. But if I own rental housing that's got strong fundamentals, or I own last mile logistics, maybe a high growth, higher inflationary, higher rate environment isn't so bad for that asset class. So as markets get nervous about some of these asset classes, that could create opportunity.
Real quick, though, where in the UK, for example? I just feel like the UK is getting hit on so many different sides at the moment.
Well, near term, obviously, the UK has a lot of supply challenges.
Yeah.
But I think the UK coming out of Brexit will find its footing. We have been the biggest foreign investor there. We really like the rule of law, again, an entrepreneurial culture, open to foreign investment. And I think the UK will continue to be a very important spot in terms of financial markets and investment within Europe, even if it's not part of the EU technically. And it's in a range of sectors. We've been doing it in real estate. We've been doing it across companies. We've been doing it in the travel and leisure space because we think Brits want to get back out. They want to travel. People want to go back there. I'm going to London in a couple of weeks. So I think Europe overall has lagged in its recovery coming out of COVID, certainly the continent, which could create opportunities. And I think people underestimate sort of the strength as we come out of this around the world. And I think it will be positive for growth, but again, challenging on the cost and inflation side.
So on that point, I'd be remiss if I didn't get your take then on the energy crisis that's happening in Europe, a touch here in the US, and then obviously in the UK. UK maybe more logistics, but the idea that as we go into this green energy transition, there's some problems that like maybe weren't really addressed or known. Opportunity or risk?
Both. The good news is we are investing less in hydrocarbons, exploration, and production. If you went back to 2014, it's down about 50% globally. So that's really positive. The challenge is for societies, that means we rely on hydrocarbons for 90% of our energy today. And as we bring the supply down, we have to bring on the supply of renewables at the same pace. And we haven't done that. Part of that is technology related, but part of that is our own regulatory framework. You covered a story where we got approval to lay a 340-mile transmission line from Quebec to Queens that will provide enough energy for 1 million homes in New York City, the equivalent of 44% of the cars taking their emissions off the road. But it has taken us 12 years to get selected and approved, and it'll take another 4 or 5 to build. And I think governments around the world have to find a way to accelerate that process. Otherwise, we're going to end up with some acute shortages, and we're beginning to see that. And so that's something we worry about. Now, on the positive side, in our energy equity and energy debt area, we're deploying a lot of capital. We've committed in the last few years $11 billion to things in solar and to wind and water, all sorts of businesses sort of as part of that supply chain. I think that's going to create a lot of opportunities. We just invested in a company called Array Technologies. It moves the solar panels to track the sun. These are very exciting things around energy efficiency. At Stuyvesant Town here in New York, we put solar panels on the largest apartment complex in the United States. So lots of exciting things. But my concern is the pace of that needs to go much faster. Otherwise, consumers are going to feel the pain, and the political will may abate a bit. And so I think what we need to do is, as a society, say, this is important to us. There's clearly capital available to invest, and we've got to facilitate that, make it happen faster.
Yeah, 12 years. That's a long time.
That is a very long time.
We're almost out of time, so I wanted to get your understanding of like what's bubbly right now.
Well, there certainly are some technology businesses, some green energy businesses trading on very lofty revenue multiples as opposed to earnings. And when we get sell-offs and concerns about rates, those companies can swing an awful lot. I think the 10-year Treasury at 1.5% and a lot of investment-grade corporate debt that's tied to that, very tight spreads over very low base rates. That, to me, seems an area where I would be more cautious. I think as investors, you want to be exposed to, you want to be invested in real estate and infrastructure and companies that can grow in this potentially higher rate environment. And so you really want to be cautious about long duration fixed income in our mind.
If 1.5% is still bubbly on the 10-year, like what should it be?
Well, if you went back pre-COVID, the 10-year was 2% and inflation was 2%. We had 0% real rates. Today, inflation's running over 5%. Now, some of that may be transitory, certainly, but 10 years, 1.5%. So that spread is almost 4% today. I feel like that could narrow. Now, inflation may come down as we get through some of these bottlenecks, but I think it's going to be higher. We've got 35% more money supply in the major markets around the world. So I think the likelihood of more persistent inflation continuing, even at a lower rate than today, I think that likelihood is very high. And so the 10-year feels like it should be higher. And so you want to be mindful of that. It will impact almost every asset class. There are some that'll do better. Insurance companies that'll be able to reinvest at higher rates should do better. But I think you want to be mindful of this as an investor.
Almost at time. Brilliant. You're counting yourself down. Thanks, John. I really appreciate it. It was so great. Having you in person makes the whole world of difference. Thank you so much.
Thank you, Alex.
All right, and thank you all for being here. Invest Global continues now with a conversation about investing in innovation. To access that, please turn to your main agenda. We hope you stay with us.
My name's Naomi Nix, and I am a social media reporter for Bloomberg News. In this role, I spend a lot of time thinking about how companies innovate and then build off of that success. And that's what we're going to talk about today. We're going to talk about what does it mean to invest in innovation. We've heard a lot today from multiple investors about their strategies, the markets, and the rates. But let's talk about kind of how those invested dollars are actually being put to work at companies like Illumina. I'm excited that we are joined today by Alex Aravenes. He is Chief Technology Officer at Illumina. And we also have Nick Kalibas. He is Head of Factor and Core Equity Product Strategy at Invesco. And Invesco is a sponsor of today's event. So, Nick, I actually want to start with you. What does it mean to invest in innovation? Help unpack how you see that issue.
Okay, sure. Let's try to unpack that a bit. When we think about innovation, we think about being an agent of innovation through the QQQ ETF. And what that really means is that the companies that are present in that NASDAQ 100 ET-based ETF spend a high proportion of their sales, their resources, on research and development. And that research and development spend leads to patents, leads to disruptive technologies, leads to doing business in new and unique ways. And so investors who are taking part in this kind of R&D spend through their investment in these companies are really able to grab stronger, more durable growth opportunities. And I think, you know, when if we went back 10, 20 years, we would think about investment in terms of more traditional plant and equipment. Nowadays, kind of in the new economy, really research and development, I think, is kind of the new currency. And so that R&D spend that happens is really driving strong earnings growth, strong sales growth, strong dividend growth. And to give you maybe a little bit of an idea on that, I mean, our partners at NASDAQ have put together some figures which I think are helpful. If you go in the 12 months ending May, 43 companies in the NASDAQ 100 that are present in QQQ had at least one patent and collectively filed 32% of all patents in deep learning, to give you an example. Likewise, almost 45% of new patents in 3D graphics in the year ending May came from NASDAQ 100 companies. So these are the types of innovations that one is able to invest in when they invest in Invesco QQQ.
Yeah, interesting. Alex, I'd love to bring you in here. What are the sort of areas of innovation at Illumina that you're really excited about? How are you kind of spending that R&D money?
Yeah, no, it's an exciting time at Illumina. So maybe just a little bit of context. So at Illumina, our mission is to unlock the power of the genome. We create technologies that people use for genomic analysis, and they use them from everything from finding cancer patients the best therapies, to understanding the health of their children, to doing fundamental discoveries into the mechanisms of new disease. We're a platform business, so our sequencing technologies are used by many other innovators. So that's something we think a lot about. How do we enable their innovation? And then there's areas, and this is relatively newer to us, where we're creating kind of full end-to-end solutions. So a new area of innovation for us, which is beyond our core DNA sequencing, RNA sequencing technologies. How do we make it easy to take samples, to automate their preparation? And then on the analysis side, analysis of genomic information can be complex. So we thought a lot about what can we do there to make the data management easy for customers, for them to get automated results so that they can get the discoveries they want, they can help their patients find their diagnoses, and do that as easy as possible.
Interesting. So obviously the pandemic has dramatically changed business as usual in the world, right? I'm curious, Alex, what about the pandemic has changed the way you think about innovation and the way you innovate?
Yeah, it's had a dramatic impact on our business at Illumina, on our technology, and also how the world sees us. So infectious disease was an important but smaller part of our business historically. Obviously, with the pandemic and the interest in understanding the virus, it became much more significant. So we actually played a very pivotal role. Our sequencers actually provided the first sequence of the SARS-CoV-2 virus in January of 2020. That sequence was then downloaded by Moderna and BioNTech, and within a little under 2 months, they had the first vaccine candidates going to early clinical trials. Along with that, we developed a COVID sequencing assay that allowed not only the virus to be detected, but to understand the variant. So you hear so much about the Delta variant, other variants. The majority of that DNA, that analysis actually comes off our instruments. We developed that product in 2 months, much faster than anything we had ever developed before. So the pandemic opened up a whole new area of business for us, genomic surveillance, genomic epidemiology, tremendous interest in infectious disease, a lot of thought now beyond this pandemic, how do we set up global surveillance networks based on genomics so we can see the next pandemic coming earlier and gain those precious months. And it really complemented a whole new method of vaccine development. In addition, the urgency of that taught us, how fast you can do things, right? You can make a product in 2 months, if you really need to, and you're innovative about how you do that. So, there's no going back from that about the new areas for us and, the innovation cycles that we can go through.
Yeah. Nick, I'm curious if you have a response to that. Is there sort of a no going back moment for investors as well in terms of how they look about which areas they should be investing in, now since the pandemic, and how they should be looking at, which companies are really set up for that long-term kind of innovation that Alex just talked about?
Yeah, I think that one of the implications of the pandemic really was related to the R&D and innovation spend that had kind of taken place and what that meant for the performance of companies during the pandemic. I mean, you think about the work at home, play at home environment that we had after the economy shut down. And a lot of that, I think, stemmed from the success of it stemmed from the fact that these investments were made and technology was in place to really keep the economy moving. And I think what is also interesting, and we saw this, is that NASDAQ 100 companies, because of that R&D spend and the innovation that they had, actually outperformed during the COVID sell-off. And investors really demanded or desired some of the characteristics of companies that were innovative because it led to more versatility, more flexibility, and the ability to grow their earnings and profits in a very adverse environment. And so I think one of the takeaways from the pandemic is investors are paying a lot more attention to a company's ability to innovate, to spend in a way that develops business that is able to kind of create opportunities. And that, I think, is really caused a lot of investors to think about innovative companies as having, maybe we'll say, something like quality type of characteristics. There's some characteristics that spend has that is very attractive to investors because they're seen as more durable, able to weather different adverse economic conditions.
Yeah. Alex, I'm curious if you have a response to that. What are the sort of characteristics of an innovative company? What sort of structures do companies that are really keen on setting themselves up for innovation put in place to foster that kind of progress?
Yeah, great question. Following on what Nick was saying, we think very strategically about innovation, right? So as an example, the first human genome that was sequenced about 20 years ago cost several $100 million, right? And so through dedicated efforts in technology, miniaturization, chemistry, leveraging semiconductors, and so on, we brought it down to $600 today. And earlier this year, we talked about the ability to actually sequence a human genome for $100, right? And part of the way we got there was making very long-term investments. So we have technology roadmaps that go 5 years, 10 years. We're thinking about what's possible when you invent new things that may not even exist today. And we make investments in those. And through that, we create shareholder value. We also create leading differentiated products. And one interesting aspect of that is, we don't know what $100 genome sequencing technology is going to be used for. We actually know many of the uses, but we don't know all of them. So some of our long-term business is going to be new applications that will be enabled. Could it be a pandemic? Could it be a breakthrough in cancer research? We don't know, but we know that bringing down the cost of genome sequencing, being able to create higher quality data, faster analyzing it, is going to be useful for the biotechnology industry. And so we're positioning our company and our customers to succeed, whatever the future looks like.
And Nick, one of your colleagues recently kind of wrote about this idea, and you've touched on it a bit, about, investors who are the most successful are often the ones who are taking that sort of long-term view. How can they be sure? Is it just numbers, but is it just sort of R&D spend? How can they be sure that the money that they're investing in is in the companies that also have a similar long-term view of innovation, like the one Alex just talked about?
Yeah, that's a great question, and I think what we've seen is the result play out in the data, meaning that we've seen kind of a big R&D spend pick up over time. I mean, if you look at R&D spending in NASDAQ 100 companies, it's basically almost doubled over the last 5 years. There's more spending on R&D the last 2 years than there is on traditional capital expenditures. And I think companies and the management of companies, I mean, they are stewards. I mean, I think they're trying to they're trying to do the right thing. They're trying to maximize profit. And so when we look at the allocation or the spend, and then we see what that is meant for returns, it's lined up very, very well. Meaning we've seen the NASDAQ 100 show outperformance relative to other kind of traditional benchmarks where the R&D spend has not been as high. So we see the faster sales growth, we see the faster earnings growth, we see the faster dividend growth as a result of the fruit of this R&D spend. And I think even when you dig down into some of the company's reports and you do the research, I mean, you can see, let's say, drug pipelines and what's going on, or you can see patent filings that are taking place. And so if you do the homework, I think there's a lot of evidence that companies are doing a good job in terms of their allocation, and it is translating into positive investment experiences for the investor.
Yeah. Alex, what some of the barriers are to innovation? Why do sometimes companies struggle to prioritize it? Or what are the sorts of things in the overall marketplace that can lead to innovations either maybe not working out or them just not having enough resources to execute it?
Yeah, another great question. We think a lot about that. So one is that there's kind of a positive feedback cycle when you get it right. So when you make those long-term investments and you have those inventions and technologies and they lead to differentiated products and you have that business success, it gives you tremendous confidence in continuing to make that as a management team, right? And we have that at Illumina, over a couple decades now. I would think it's also appreciated by the investment community when they see a high R&D spend. We're about 18%. And they see that pipeline and that relentless commitment to differentiated products over time. So I think when you get it right, it gives you a lot of confidence in your model for doing that. You talked about barriers. We think a lot about disrupting ourselves, right? So not being comfortable. What's the next frontier? What are other areas we should get into? We don't want to be disrupted by someone else. We want to, disrupt ourselves, right? So I think you need that cultural mindset, so you don't just, rest on your market position if that's a good one.
And Nick, any thoughts about some of the barriers that companies are facing to innovation?
Well, I think that when we think about it, I think the environment to innovation is actually a lot easier now than maybe what it was 5 or 10 years ago, because I believe investors are very hungry for growth. I think people have want to be kind of like growth investors, and they are kind of forgiving in terms of that spend, because they believe that it can lead to something. And so I think that you've heard the kind of the growth value debate in the market, for example, and you'll see a lot of investors nowadays they're kind of cautious about that value, because it's seen more cyclical. It's not seen as secular, and so I think investors have really adopted kind of the growth orientation for investment. I think that the barriers, specifically, it's kind of up to how far companies and technology can kind of push themselves, and it seems that as time has progressed and we see innovation data, we see everything that's happening, it seems that the door continues to kind of open up and create opportunities that we weren't thought was present 5 or 10 years ago. So I kind of think the runway is still very, very large, and I don't think there's going to be something that really inhibits kind of the innovation that we can see in the future.
Well, let's talk about the future and looking into the future. Alex, what are sort of the innovations on the horizon, either at Illumina or sort of out in the broader kind of business ecosystem? What are some, 10 years from now, what are some of the sort of hot spots of potential innovation that we might want to be looking forward to? And feel free to guess. There are no bets on the table here.
Sure. A few things there. One is on the data side, right? So we produce a huge amount of genomic data, our customers do. We've come to appreciate the value in that. So not just in terms of immediate insights or diagnoses, but when you have large amounts of data and you have good approaches to machine learning or deep learning, you can develop methods that can go far beyond anything we did in the past. So we've had some early successes with that, demonstrating more of the genome that can be valuable, deeper insights, and we think it's just the beginning. So we're investing a lot more in our data infrastructure, data engineering, much larger machine learning and data scientists, and really seeing the benefits to our products and our customers. In the pharmaceutical industry, there's been, over the last year, some exciting new drug targets that came about through very large genomics data sets like the UK Biobank, where when you have 500,000 samples and you have really good medical information, machine learning algorithms can find things like new targets for obesity or cardiovascular disease that you couldn't have found in smaller data sets. So we think that's an ongoing trend that's going to be really exciting over the next decade. Another, I think it's important to mention, is company creation and early companies, right? So there's a lot of people who start companies using our technology in new applications, therapeutics, also diagnostics. We've created an accelerator, and in our company accelerator, we catalyze new company creation. We've also started to do that globally. That's another trend we're seeing is going to be very important to our and the industry's future, is new companies and new innovations, not just in the United States, but in Europe, in China. We just partnered with a prominent venture capital firm there, Sequoia, in China, and started a new genomics accelerator.
Wow. That sounds like a lot to look forward to, and to see, what Illumina comes, to the market with. Thank you both for joining us today. This has been a fascinating conversation about innovation. I know everyone appreciates it, and I definitely appreciate your smart insights on this topic, and I hope that we get to talk about it again someday.
Hi, I'm Mark Millian, managing editor of technology news at Bloomberg, and I'm here virtually with Guru Chahal, partner at Lightspeed, one of the more prominent venture capital firms in Silicon Valley. And Guru, one of the I guess a big area that you specialize in is sort of technology infrastructure, internet infrastructure. Which I think maybe for a lot of our audience is something they don't think a lot about normally. Maybe they don't care a lot about, and they just think, you know, like the infrastructure on the internet is fine. Like I can look at my phone and open Facebook or Instagram and know that it's always gonna, well, except for yesterday, I guess, right? So I think yeah, you know, our the massive Facebook outage that we followed yesterday was a good example of why you do what you do, and why you're interested in how technology works. So tell me a little bit about what was going through your mind when you know it felt like half the internet was down.
Mark, thank you so much for having me. It's a pleasure to be here. And you're right. I've spent a lot of my time thinking about the infrastructure that really underpins all of technology. And the reason I do that is because of two reasons. I'm a geek, and I really love understanding how things work. It's sort of like the person who thinks more about the foundation of the house than the house itself. And two, it's a great market. It's a really, really large market. If you really think about the network infrastructure, the internet, the compute infrastructure, storage infrastructure that just underpins all these things we use on a day-to-day basis, including this application that allows us to talk, that's $1 trillion market. And so a lot of value creation there. And yesterday, all of us got introduced very quickly to how critical that infrastructure is. So I'll tell you a funny anecdote. I invest in companies globally, here in the US, in Israel, in Europe, as well as in India. I found out through about the outage because I got an email from one of the CEOs I work with who's based in Israel. And I never get an email from this person. I always get a WhatsApp message from this person. And so the alarm bell went off as to what's going on here. And that's how I found out that WhatsApp was down. And just shows you how critical the underlying infrastructure is. And in this case, what happened was it was more of an operator error where somebody apparently at Facebook misconfigured one of the routers that moved traffic around from our computing elements to Facebook's data centers. And so no one really knew how to get to a Facebook data center. And so that resolution of how does your browser get to a Facebook data center got broken, and nothing was working for quite a while.
How would you describe the state of our internet infrastructure? Like what is, I guess, the investment opportunity there?
So the total spend on all of internet underneath consists of about $15 to $20 billion of elements called routers or switches. And they are the ones that really move all the traffic between our devices to data centers, to applications, or to the cloud and back. Over the last about 10 to 20 years, the remarkable thing about that market is it hasn't seen much innovation. And there's, for all practical purposes, only one company, which is about a $25–30 billion company today, that was created in the space called Arista Networks. And they've done remarkably well, but they address one part of the network infrastructure. We are very excited about other parts of the network infrastructure that are seeing increased amounts of innovation right now. And that's thanks to what happened yesterday. So there's an increased need for capacity in the internet and the ability to troubleshoot and keep it reliable. And two, 5G, which is now enabling us to get really high speed, high performance connections through our cellular devices out to the internet. So we're investors in companies like Arcus, for instance, that are rebuilding that part of the what's called the BGP stack. or the BGP protocol, which is really one of the contributing factors to the outage yesterday. So that piece that requires innovation, we're very excited about investing in those themes.
So you said the infrastructure is outdated. The folks in Washington talk a lot about fixing our roads and our bridges. Do you think we need an infrastructure bill for the internet?
I'm obviously a prejudiced entity, but I believe we need it even more critically than we need just roads and bridges in some sense. I mean, compare the time, Mark, in the last 1 year that you spend on the internet versus the time you spend on the road. And I think that'll give you a preview of what's going to happen over the next few decades as we digitize, as society as a whole gets more and more digitized. So I think focusing on the digital infrastructure is not just important for you and I, for the federal government, but it's a national imperative. How good we are at that underlying infrastructure will govern how good we are in the competitive stage globally in the future as well. I think the current national infrastructure in roads and bridges, in transportation, in building up our economy has built the nation and given us a preeminent spot on the world stage, but continued investments in the internet and in the digital infrastructure that underpins our lives on an increasing basis is going to be critical for continued leadership over the next 10, 20, 50 plus years.
Yeah, I'm not sure I would bet on Congress for fixing this one. So for investors, where do you think the fix is going to come from? Is it going to be big companies, small companies?
There's a reason why there are very few companies at the intersection of big and innovative. Like this just doesn't happen very often, and that's because structurally it's really hard. And of course, management consultants and professors at business schools are going to tell you it can be done, but the real issue is one of incentives. There's no incentive as a big company to take risk or be revolutionary when you can, take an evolutionary approach and net more profit. What innovation comes from small teams of highly motivated individuals where the incentives truly line up. Think of the most innovative CEOs that have taken technology companies public in the last few years. I doubt any of them would go and want to do the same thing inside a large company. You just cannot. Startups innovate because lack of innovation is a near-term existential threat. Let me take a brief example. So we're on this virtual conference right now. Last year, when the pandemic hit, so around the Feb-March timeframe, there was a team that used to do technology for physical events, right? So they were it was a great business. They were selling technology supporting physical events. That business went to literally zero. And in 30 days, the entire team had to retool to take their technology stack and build a virtual event platform. And it's one of the fastest growing teams. And that's the point at where we invested in the team. The name of the company is Hubilo, and they're one of the fastest growing virtual event platform globally today. And that kind of retooling in 30 days, that kind of innovation is practically impossible at a large company because, frankly, that pressure for that kind of innovation just does not exist. So we're extremely excited about the startup ecosystem to go take on some of these challenges, whether it's the infrastructure layer or the application layer. We believe that's where true innovation comes from, because those are the most incented individuals that are structurally set up in the right way to drive big changes in society.
Now, I want to take a step back for a minute. We've been talking a lot about your area of expertise, but Lightspeed as a firm invests in a lot of different things. So we have a question from someone in the audience. Tom from New Jersey asks, what is the most innovative space you see right now? Biotech, crypto, and where do you see the most upside?
These markets are so large that at a global level, we track almost every market from crypto to healthcare, biotech, enterprise infrastructure, enterprise applications, consumers, social, media, across every vertical you can think of. And the reason for that is, smart founders who think very deeply about their markets and think very deeply about businesses will always be looking to disrupt those businesses and do something better. So we're at a global level. So Lightspeed is a global partnership. We invest here in the US, we invest in Europe, Israel, India, China, Southeast Asia, with feet on the ground, with investors on the ground. And we don't tie ourselves necessarily to, hey, we're going to invest only in this vertical or that vertical because that's where a lot of the innovation is going to come from. We believe innovation comes more broadly across the entire ecosystem. Now, having said that, I think the two examples that were just pointed out are probably where we are seeing some of the most active and some of the most active innovation going on right now, both in crypto at the blockchain level, at the commerce level, and then in healthcare and biotech as well, at the drug discovery level or in how we deliver healthcare. And we're investors across all of the segments.
So I want to go back to what you were talking about earlier about the differences between innovation inside big companies and small companies. You have firsthand experience with both as an investor, but also having worked on a number of startups, including one that you sold to Cisco and another to VMware. So I think we've all heard a lot about being acquired and what that means for a startup, often for the worse. But I'm curious how an acquisition can change a big company in your experience.
Let me address the second part of the question first, and then I also want to comment on your for the worse comment for the startup, because it's not quite the case in a really good acquisition. So let me start with how can an acquisition influence a large company? And I think there are three key benefits here that when done right, the acquisition accrues to the large company. One is the business, right? So you're acquiring revenue that might or might not be accessible to you as a large company. So I'll give you an example. You mentioned I've sold two companies over the years, one to Cisco and one to VMware. If you take the VMware example, there was a company called Avi Networks in the cloud infrastructure space. That company sold a product that VMware just simply did not have. So by acquiring, the first benefit was the business. So there's tens of millions of dollars of revenue or top line that accrues immediately to your top line. The second benefit is talent. A couple of hundred really entrepreneurial employees, great engineers, marketeers, sales reps, they all got acquired as part of that transaction into VMware. And that's amazing talent, especially in a tight hiring market. These kind of entrepreneurial leaders, these kind of engineers, these kind of sales reps, it's exceedingly hard for a large company to go out and hire them on their own. So an acquisition like the acquisition of Avi by VMware can really accrue massively to the talent base. And then the last thing, and probably the most important one, is goodwill. If you really think about the acquirer, from an acquiring company's perspective, they get a huge benefit from taking innovative, well-loved new products to their existing customer base. And so the existing customer base looks at them as a more innovative company than they would have if the company was showing up day after day after day with the same set of products. So I think you benefit from having bought the business, the actual revenue, you benefit from getting amazing talent, and then finally you benefit from having an innovation halo around you, so your existing customer base really looks to you for innovation rather than you losing account control and and the customer really going to other more innovative companies.
Makes sense. I want to take another question from the audience. So this one is, speaking of innovation, what are your thoughts on quantum computing and its near-term impact on internet infrastructure?
I think quantum computing impact represents one of the biggest leaps in computing we've done basically since the dawn of computing. However, as an investor in private markets, we tend to watch very carefully where a technology has taken the leap to be ready to be converted into a business. So there's often in technologies, there's science risk. After science risk comes the risk of actually producing it. And then the risk that, hey, do you have the right use cases pinned down so that the customers really see value and you can create a business around that by selling that particular technology. With quantum computing, our questions are largely around at what stage is it ready to address mass market use cases. And so we're tracking it very carefully. We're pretty excited by the potential there. And we are in touch with a lot of the top startups in the space. We're not active investors yet in one of the quantum computing startups, but it's a space we're pretty excited about.
So you were a VC at Lightspeed years ago, and then you found a team that you liked so much that you mentioned earlier, Avi Networks, that you quit your job to go work with them. What do you, I guess in that example, and then maybe we'll talk more generally, what do you look for in a startup that is so inspirational that would make you want to take that leap?
The most important thing about any team you ever work with, as you know, Mark, is the people you work with, right? If you're excited about going to battle every day with your colleagues, taking over the next hill, having a big mission in mind and being confident that you can trust them and you respect their skills and they are committed to the mission, there's nothing better than that in life. That's the first thing I look for as an investor in the teams that we invest in. That's also what got me super excited about joining the team at Avi. This was an amazing team I'd known for a few years. When they were leaving Cisco and looking to start their next business, we got talking, and it didn't take very long for me to go, you know what, I want to go to battle with you guys. Like, this is really amazing. And they felt the same way. So it starts with the team. The next most important thing is the market that you're taking on, because if the market's not large enough, it just becomes really difficult to attract great talent, because great talent wants to have true impact. If you ask yourself, why do folks ever join a startup? Why give up a nice, relatively safe, high-paying job to go take risk at a startup? And that's because they want to have an impact. And unless the market size is large enough and you can impact businesses and individuals in a way that really sort of makes you feel like you did something that was outsized and over and above what you might be doing deep inside the bowels of a company like Google or Cisco or an HP or a Facebook, they would never come. So I think those are the two big things I look for. That was what got me excited about Avi as well. Amazing team and a really, really large market. In fact, I guarantee, Mark, that your lives, as well as most of our listeners today, Avi's technologies have impacted their life in some way or the other. I mean, the customers included some of the largest websites on the planet, and it's quite possible that the next time you log into your banking website or application, or the next time you buy a car online, or the next time you do your taxes online, it's quite likely that the technology underneath that's making that possible is Avi Networks technology. Now, when you have that kind of mission, that kind of big vision, and that kind of impact, it just makes everything easier, including hiring.
Is there a third criteria that you think about to avoid like a potential disaster scenario? Like you think of Theranos, it's like blood testing, big market opportunity, inspiring, magnetic entrepreneur, or WeWork, like commercial real estate is huge, and the entrepreneur is like really has a lot of people who want to follow him around. Like, what is there a third criteria to avoid the pitfalls?
Yeah, so I spoke about the team and the market. There's actually two more, which are very connected to the example you just gave. The first one is technical diligence. From a technical perspective, can we speak to enough experts to convince ourselves that this is doable? That we're past, let's say, a science risk or some sort of an R&D risk that is extremely binary in nature. From a venture perspective, certainly that's a kind of risk where we want to go in with our eyes wide open. And then the fourth thing is really, does the business founder, that combination, does that make sense or not? And in case of WeWork, I fundamentally believe that businesses like that have a place. I mean, that's why the underlying idea of having small remote offices or environments where employees can go and spend some time made sense. In fact, at my last startup, other than the office in Silicon Valley and 2 other remote offices, all of our other offices were, small spaces leased from companies like WeWork. So the idea makes a lot of sense, but at the end of the day, the business metrics have to make a lot of sense as well. So those are the 4 things we look for, not necessarily in that order of priority, but the team, the market, technology/science risk, and then just the underlying business fundamentals, unit profit, gross profit. Does the underlying business give you the potential to really disrupt the market in a big way? I think those are all things we are very careful about leading into.
Okay. I want to take another question from the audience, which is back to infrastructure. What private investments can be made to make internet infrastructure more resilient? Is there a market specifically for this?
Yeah, so the underlying infrastructure, there's about $40 to $50 billion spent every year just between telcos and large enterprises on getting the internet to work. Those are big hardware devices, routers and switches. They're also software that actually manages that infrastructure, troubleshoots and diagnoses when problems happen, just like yesterday and so on. So we are very active investors in this space. I'll give you a couple of examples. There's a company in our portfolio called Arcus. Arcus today ships one of the highest performance internet software in the world. So that operating system is used today by telcos and really large web-scale enterprises to run their networks. So you can imagine as more of that kind of technology, extremely resilient, extremely high performance, makes it into the larger internet, the internet as a whole continues to get better. We're also investors in companies that are making last mile connectivity a lot more resilient. So companies like Solona, which is making 5G connectivity or using CBRS, which is a particular band of radio communication, utilizing that to provide high performance connectivity to devices. We're investors in companies like Fiat that actually make this communication a lot easier to do because they provide high performance last mile connectivity to remote workers. So we're extremely bullish on investing behind companies that are making the overall network infrastructure better and more resilient, and we believe it provides a big opportunity for value creation.
All right, Guru, I think that's all the time we have, but thank you for coming on to talk with us, and thank you everyone out there for coming to listen.
Thanks.
Thank you for joining us at Bloomberg Invest Global. We hope you enjoyed these conversations, and thanks again to our speakers for a wonderful program. And thank you to our U.S. presenting sponsor, Invesco QQQ, and our presenting sponsors, Abu Dhabi's Investment Office, Angola's Investment and Export Promotion Agency, Grayscale Investments, Do Business Jamaica, LetterOne, Qatar Financial Center, and our supporting sponsor, CMC Markets Connect, for making this virtual summit possible. If you'd like more information about our sponsors, please visit the Resources tab on your screen. And most of all, thank you for being such an engaged audience. Remember, we've got 2 more days of terrific conversations and practical insights ahead of us. So please join us tomorrow for day 2 of Bloomberg Invest Global. I'm Shonali Basak with Bloomberg News. Thank you for joining us.